Good morning and welcome to the June 2023 UCLA Anderson Forecast Conference. We're really pleased to be back in person and growing our in-person audience. For those of you who are coming in through the remote portal, welcome as well. You're missing breakfast, by the way, by being remote. And so to begin, I'd like to make a few introductions and announcements, and then we'll jump right into the program. We have a great program today. We're going to begin with the forecast and talking about the U.S. and California forecast. But the first part of our program, first part of our forecast program, Professor Ed Leamer, who is to my left, and to your left, far left, Professor Leamer has been at UCLA for, he doesn't want me to say how many years, for a lot of years.
Don't say that number.
So I won't say that number. Ed was director of the forecast for 17 years. My predecessor and mentor is now distinguished emeritus professor. And he's going to talk about some research that he's done on this question of soft landings and hard landings, which is going to lead into our national forecast, and that'll be by Leo Feller to Ed's left. Leo comes to us from consulting, but also teaching at Johns Hopkins, earned his PhD at Brown University, and then I'm going to be following that with the California forecast. I think most of you know me, but for those who don't, I'm Jerry Nicholsberg. I'm the director of the UCLA Anderson Forecast. And I've been here now pushing 2 decades at Anderson. So that will be our forecast presentation. We'll have some time for Q&A. It's going to be first Q&A from the audience here in person. But if you are online, please look at the Slido login and put your questions there. And if we have time, we will get to your questions. We won't have time for all the questions, obviously. So then we're going to take a look at the latest results from the just finished Alan Matkin's UCLA Anderson Forecast Commercial Real Estate Survey. And following that, we have a great panel on what's happening in commercial real estate. That'll be preceded by a talk by our own David Schulman on finance and commercial real estate. So that's the program for today. Big program. So we want to get going quickly here. So before we do, I'd like to, first of all, thank the Ziman Center for Real Estate here at Anderson. They are partnering with us and certainly support this event. And special thanks to Richard Ziman and Steve Gordon for establishing the Ziman Center Real Estate Economists, which will be joint with the forecast. And that position is going to be filled by a new PhD out of UC Irvine, Sayantani. She's doing really interesting work. And in fact, she and I are working on some research right now. So look forward to that. We also want to thank Edison International and Southern California Edison for their sponsorship in starting the Forecast Fellows program. And we have now our 2nd year of the Forecast Fellows program, which is providing pathways for students at Cal State Dominguez Hills into graduate study. And our latest fellow is Dwanye O'Brien, and he's starting some really interesting work on food sustainability in underserved communities. So many thanks to them. And then finally, before we get started on the program, I want to thank our sponsors. You know, we're a public institution. You all have heard about the budget. We couldn't put on these programs or do our research without the generous support of our sponsors, and we are enormously grateful to them. And so our sponsors today are at the principal level, RSM, and Yamava Resort and Casino at San Manuel. Our platinum sponsors, the law firm of Alan Matkins, California Bank and Trust, Cathay Bank, Clark Construction, Leap Development, and University Credit Union. At the gold level, Avenue Insights and Analytics, California Steel Industries, Hub International, Pacific Western Bank, Robert Half, United Airlines, and Venture Forward by GoDaddy. At the silver level is Bank of California, Hathaway Dinwiddie, Manufacturers Bank, US Bank, Private Wealth Management, Valley Bank. At the bronze level, Hanmi Bank, HDR, Marsh McClellan Agency, MBK Real Estate Companies, Summit Design and Construction. At the Bruin level, Gerber Kawasaki Wealth and Investment Management, and Ely Commercial Real Estate. Many thanks to our sponsors. Again, we couldn't put on these programs without you all, so we very much appreciate that. And so with that, let us turn to hard landing or soft landing, or what do we know, Ed?
Okay. Is this mic working? I guess it is. So Jerry's introduction of me reminded me that yesterday when I fell down, I started thinking I should run for the presidency. Think about that as a possibility. Today, I want to leave behind a message that I try to get across to students when I'm teaching data analysis, which are pictures, stories, and numbers. Pictures, stories, and numbers. Humans are best at processing visual images. We're pretty good at stories that memorialize those visual images, and nobody understands numbers. And typically, the econometrics and statistics teach only numbers, and they don't deal with these other issues. So I want to answer the question, has there ever been soft landings? And that's the plane that Jerry was flying not too long ago. We're going to base a lot of the predictions and analysis on the slope of the yield curve. These are bond rates from the New York Times. It said today, which was a few days ago, and a month ago, and a year ago. And you can see that a year ago, we had what's considered a steep yield curve in the sense that the 3-year bond was 1%. They had a rate of interest of 1%. The 10-year was 200 basis points higher at 5%. But now we're reversely reversed with a negative 200 basis points, with the 3-month paying 5% and the 10-year paying more than 3%. So the real question is, does an inverted yield curve predict a recession? And that takes two kinds of stories in order to memorialize it. You're going to see images in a minute that explain the evidence about the inverted yield curve and the recessions. But that evidence comes to life only if you have a story explain why an inverted yield curve either is a prediction or a cause. The predictive story is that people in the bond market are normally going to expect a higher rate of return on 10-year treasuries than on 3-month. Why would they ever buy a 10-year treasury when it pays a lot less than a 3-month? Well, if they knew that 3-month was going to drop dramatically in the next year, they would want to lock in that long-term rate while they had that opportunity. So that's a prediction. The Fed is going to be forced into a reversal of their monetary policy and lower that interest rates. So that's the bond market predictive of an inverted yield curve in a recession. The causal is that banking sector makes intermediation profits by taking deposits at low rates and many loans at higher rates, longer term loans. When that yield curve flattens or even inverts, that source of profitability for the banking sector disappears completely. And the banks have to think about other ways of making money. In particular, they have to distinguish between those who are going to pay the loans, those who are going to be good loans, and those who are going to be bad, which means you get elevating lending standards. And when you have a significant elevating lending standard, particularly in the housing sector, you lose out on a huge number of potential buyers. So that's the causal story. I've lost control. Here's the number, the 3-month treasury, which is that one, and the yield on the 10-year is that blue. And you can see that before that recession, which is that dark color, there was a kind of equation of the two rates. And another case where they were equated an inverted yield curve. And here we're in a really extraordinary circumstances. We never see the Fed jacking up interest rates like they have over the last 6 months or so. It's just unique. But they've created a significant inverted yield curve. So here's the image of why that matters. The horizontal axis indicates the months before the next recession. So what you see in front of you are the 3 years of data in the last 3 years of expansions. To the right is the recession. That's an image of the slope of the yield curve, the difference between the 10-year rate and 3-month rate for the expansion that ended in 1957 August. You can see that the yield curve got a little flatter over to the right in the year before the recession. So let's add more of these images here. These are all the 7 options that we have. And I think you can see that over in the right in that last year, you get a bunch of low slopes, and many of them are inverted. And you don't see them much in the year before or the 2 years before. And that's the average. And we're gonna think about now taking the most recent data and inserting it into this picture in a way that it fits best with the historical data. And you can do it yourself. You don't have to rely on me, but I'm going to give you my selection, which is an econometric selection. Those triangles represent the most recent 6 months of data. So you think, well, I pushed that way to the right, you want to move it to the left. Well, if you move it to the left, it comes more and more inconsistent with historical data. There's only a couple of cases that in the 70s, Volcker and Burns, that are similar to the example that we have today. Those were followed by terrible recessions. On the other hand, if you work with 12 months of the data and you try to put all 12 in that picture, there's a problem because those earlier months had steep yield curves. They didn't have inverted yield curves. So you take that 12 months and you try to move it back and forth, it's going to fit the data less. So I'm telling you, this is the kind of arbitrariness, ambiguity that afflicts any inference from non-experimental data. There are 2 walkaways from these images. One is that the recession is going to start next month. The other one is going to start in about a year, 11 months. And if you think that's not true, then you've got to tell a story that explains why the predictive story and the causal story don't work in this circumstance. And maybe we'll hear about that later on. These are the slopes of the yield curve. And the red lines represent the periods of declining slopes. So that's a declining slope. That's a declining slope. So what I'm going to do is an episode-based analysis in which I identify the 16 or 17 different episodes of declining slopes, and then describe numerically what those episodes were like in terms of length and depth, and then look at the following episodes of unemployment and describe them in terms of length and depth and various things, and then see if there's a connection. Does the length and depth of these episodes predict what's going to happen to the unemployment that comes subsequently? So here's the unemployment data. The same coloring that you saw before. So these red shades are periods of declining slopes. And then this is the unemployment rate, not the slopes that's being illustrated. So I'm asking in this picture whether there's connection between the periods of declining slopes and the subsequent changes in unemployment. That's the question that's being answered here. So you can see in that one white period, which is between 2 periods of declining slopes, you had a spike up in unemployment. There's the next one with a spike up. And over here, there's a spike up as well. But there's one episode where there was no spike up in unemployment. That looks like a soft landing. So I look at this visual image and I see, 3 different numbers, 5, 7, 11, and 13. 11 and 11A and 13A are a reference to the same interest rate changes that the Fed was making. But those are the periods of what seemed like a soft landing. But when you use an aircraft metaphor, you must have a pilot in mind. It isn't that the wind changed and saved the pilot from crashing, something that the pilot did. Well, those two episodes you're going to see in a minute, they had soft landings. The number 5, because the Vietnam War you had that fiscal stimulus from the huge spending of the Vietnam War. And the other one, at number 13, is the internet rush. It looks like it was ready to have a recession in 1995, but along comes the internet rush. So those were the windstorms that prevented the pilot from crashing, even though it wasn't the Jerome Powell or whoever was in charge at that point isn't the one who's responsible. So here's the images of the unemployment and what I'm identifying in those soft landing episodes. And you can see the unemployment keep on going down right through it. And here's all the other episodes in which the unemployment rate is spiking up after the interest rates start to rise. So that vertical line in these graphs represents the minimum of the slope. And the slopes are declining to the left and they're rising to the right of that line. And you can see what happens in unemployment. So then the question is there a difference between these two subsets of events in terms of the slope of the yield curve? So here's a soft landing. That's the slopes that you see. And you can see that except for episode 5, which ends in October 66, in the beginning of the Vietnam War, those other ones didn't have an inverted yield curve. They got slower. They got lower, but didn't have the inverted yield curve. If you look at all the rest, most of those have inverted yield curves. So this image is supposed to be a warning for the Fed. You can try to slow the economy down, but if you're expecting a soft landing, you better go easy on this and not give us that terribly inverted yield curve. But again, they do not buy into the stories that I told necessarily about why the yield curve is both a predictor and a cause. So what I've done is to collect features of these all these episodes. And along the top, those are the features I'm going to use to describe those episodes: the minimum slope, the maximum slope, the average, the length of time it was in place, the number of observations that were negative, number of months that gave you negative slope, the difference between the min-max, the rate of increase, and the severity. And then you can see that I wanted to bring attention to what you saw in the visual images, which is episode 5 had an inverted yield curve, even though it didn't have a recession because of the Vietnam War, is what I would say. But then episode 7 is 133, 11A or 2.0, et cetera. And those are all positive. And then you look up and down that column, you can see there's a lot of negatives. So it definitely seems like an inverted yield curve is a symptom of oncoming recession based on this set of observations. And then we're going to build a correlation matrix between features of the episodes of the slopes and features of the episodes of rising unemployment. Okay, the rising unemployment either begins within the slope period or right at the end of it. And we're going to look at a minimum, maximum, et cetera, for the slopes, and then the horizontals, similar things for the episodes afterwards. So then you can see that there's an 82% correlation between the maximum slope and the average, and a -68. And if we had time, we could go through each one of those and talk about what it really means. But I'm going to focus on these 3 ideas that focus on what's the predictive value of the minimum slope, like an inverted yield curve. We look at the length of the unemployment rise, that's the number of observations, the total increase in unemployment, which is maximum minus minimum, and the rate of increase in unemployment, which is the increase divided by the number of months that occurred. So this is a picture that shows you the scatter diagram between the length of time of rising interest rates and the minimum slope. And the horizontal axis is the minimum slope. And I fit a equation, a quadratic equation. It seems kind of uncomfortable And what you notice is that there are two episodes 9 and 10, which are pulling that curve downward. And episodes 5 and 13, which I already made a reference to, are also outliers when it comes to that scatter diagram. So I'm going to add in some other variables, if you want to put it that way, to help explain this. One is the episodes 9 and 10 in the Volcker era had just incredible declines in the slope, and then jacked it up and decline again, and so very short-lived and highly volatile. Maybe that's why it wasn't, you didn't have the hard landing. And then I've said this before, the other episodes 5 and 13, there's the Vietnam War and the internet boom that explains why those were soft. This is the similar quadratic that explains the increase in the unemployment rate. And the last one is the rate of increase, and we end up having linearity there. So I'm going to use this data to form forecasts of the unemployment change that's going to come in the event that we have a recession sometime soon. And that's going to be based on these variables in a multiple regression. You have the minimum slope, you have the average slope, your number of observations when the slope was declining, the number of cases where the slope was negative, the rate of decline of severity, and I've given you those sample means, historical means for all those things. And the April 23 number, we're going to estimate the equations, and then we're going to use the April 23 numbers, which are like a minus 1.52 for the yield curve, and stick those into the estimated equations in order to get forecasts of the features of unemployment. I don't have enough time to really do this legitimately, but here's the conclusions. That's the historical data. The mean increase in unemployment in these episodes was 1.93. The forecast, if you use the full equation, is 2.1. Expect to see a 2.1% increase. If you concentrate the limited data evidence on a smaller number of variables in what's called stepwise regression, whether that's wise or not, we can talk later on about, but then it jumps up to a 5% increase. So it's a very severe increase in unemployment comes next. So bottom line is, I think we should be worried about what comes next. And then these are the other variables that I threw in implicitly. There's a Korean War that had a big increase, and then that negative Korean War created a recession in 1953. There's the Vietnam War that I said before, the Reagan buildup. These are also driving the economies, not just the Fed. Here's the intellectual booms. That's the information processing equipment and intellectual property products. That's the contribution they make to the growth of GDP. Growth of GDP is like 3%. So when you see a 1.5 in that image, that's a lot of contribution from these pretty small sectors. So a message that I want to get across is there's two problems of drawing inferences from non-experimental data. If you don't have randomized treatment, it's almost impossible to draw causal conclusions, since the patients who get the most medicine have the worst outcomes. It's not because the medicine is causing the outcomes, it's because the outcomes are causing what the doctors provide. And then secondly, if you don't have experimental controls, there's all kinds of other variables that you can add. I've done that I've looked at these outliers and said, well, we can explain this and that. I only have 15 observations here in terms of the episodes, only 15. And so you can overwhelm that with all kinds of controls and make all kinds of different inferences depending upon the controls that you add into that equation. So for me, I would like to leave this idea that you should walk with me in the direction of humility, or you can go in the other direction, that the rest of the school in the data science direction. Thank you for listening.
Thank you, Ed. All right, I'm going to stand on the side of humility, but I'm going to bring in a little bit of the data science as we talk about whether or not we're going to have a recession or no recession going forward in the US. So this forecast is actually not all that different from the forecast that we provided to you about 3 months ago. And again, not all that different from the forecast we provided to you about 3 months before that, right? So we've been saying consistently, it's very uncertain whether or not we're going to have a recession. And even though there were calls for a recession this time last year, We're still not in a recession, right? So if you remember back this time last year, this is June 5th, 2022, Cardi B comes out and says, when y'all think they're going to announce that we're going into a recession? Consumers were already pretty pessimistic. I mean, Cardi B has 30 million followers. So by the time Cardi B says we're going into a recession, there's a lot of consumers who are listening to her and thinking that we're going into a recession. This is back a year ago. 6 months later, Cardi B comes back and says, look, we're going through a recession, Merry Christmas, right? So at this point, 11.9 million views, right? This is a non-trivial portion of the US population that's hearing Cardi's views about whether or not we're in a recession. But even Jamie Dimon, this is back in October of 2022, is saying, look, this is serious. We expect to tip into a recession 6 to 9 months from October of 2022, which means that we would be in a recession today. And sure enough, our economy has remained incredibly resilient. We're not in a recession today. If you actually look at what has been happening to business investment, it's still thriving. If you look at consumer spending, it's still thriving. There are parts of the economy that you can say are in a recession, right? So the goods portion of the economy, we're not buying quite as many goods as we were before, but we're all here in person, right? And you might have driven your car and used parking services. You might have taken an Uber and used transportation services. And we just use catering services to be able to provide breakfast, right? So this is all the service side of the economy. And this is the side of the economy that's still incredibly resilient. If you look over the course of data, how long have we been saying that we're going to go into a recession? The chart on your left is going to give you the probability going all the way back to 1968 that we're going to enter a recession in the coming year, right? So this is a poll of about 70 economists like ourselves from the Philadelphia Federal Reserve. And they're asking, look, what's the probability that you think we're going to have a recession in the coming 12 months? And as of Q4 2022, this probability was about 45%, right? So as of about November of 2022, the group of about 70 economists were saying 45% chance we'll have a recession in the coming year. This is the most anticipated recession we'll ever have since 1968. If you can look at the height of the line, right, you can see that we've been talking about this recession now for a really long time. But if you look at the depth of the recession, this was a two-part question. Part one was, what's the probability that you think we'll have a recession? And part two was, how big do you think the recession is going to be? And this little tiny dot that you could barely see is the depth of the recession peak to trough, right? It's about 0.3%. So it's basically saying the economy is going to contract 0.3%. If you look all the way back to 1949, those are the bars going down. This is a tiny itty bitty recession, but oh man, we can't stop talking about it, right? So we're really anticipating this recession to come about. We just didn't expect it to be all that big. So in the spirit of humility, as Ed pointed out, we're not going to forecast a recession. We're not going to forecast no recession. We're going to split the baby and talk about a recession scenario and a no recession scenario, right? We don't really know which way things are going to shape up at this point in time. But if we go down the recession scenario, what we expect is that the Fed is going to increase interest rates up to 6 to 6.25%, but it's going to start cutting interest rates sooner, right? So a little bit higher, but then start cutting. We'd expect a mild contraction in the third quarter, starting in the third quarter of this year and lasting into the first quarter of 2024. We expect unemployment to go up to 4.5% by early next year. So a more rapid increase in unemployment. And then inflation is a little bit higher initially. And this is why the Fed actually had to be a little bit more aggressive, but then it starts coming down because the Fed has forced a recession and caused demand to slow down. That's the recession scenario. And I'll show you a bunch of charts to actually make this a little bit more clear. In the no recession scenario, the Fed has one more increase in interest rates, or sorry, 50 more basis points to increase interest rates. So perhaps not increasing right now, next week in June, June 16th, 17th is their meeting, but maybe increasing in July and in September, and then stopping, but keeping rates higher for longer, right? In either case, we still see the Fed as not being done with its job. It still has a little bit more to go in increasing interest rates. We expect an economic slowdown, but no economic contraction. And we expect a gradual increase in unemployment, but inflation might not be quite as high now as in the recession scenario, but it's going to stay a little bit higher because we as consumers don't really pull back. So let me show you what this looks like in figures. First, quarterly real GDP growth. So we normally see 2.2% growth on average over time, right? Over the past decade, we average about 2.2%. So anytime we dip below 2.2%, we're growing less than we normally tend to grow. What we expect to see in the green line, the no recession scenario, is that economic growth slows to about 0.8, 0.9% at an annual rate. So below that 2.2% rate that we're accustomed to. And in the recession scenario, we actually get economic growth contracting, or the economy contracting by about 1.5% in the third quarter of 2023, negative 0.8% in Q4, negative 1% in Q1, and then 0% and starting to grow again and having a little bit of catch-up growth. And that's why the red line is above the green line as you get towards 2025. But what I also want to bring out is if you think about when Cardi B was sending out her tweets in June of 2022, right? That's the second quarter of 2022. We had just experienced 2 negative quarters of GDP growth, right? Not quite a recession because employment was still growing, even though parts of the economy, the good side of the economy was contracting and people were kind of feeling this uncertainty about what was going to happen. That was enough to make us feel like we were in a recession, even though we were not in a recession. The difference right now in this red line is that it's a little bit deeper for a little bit longer, and then that's it, right? Still relatively mild. If you think back to June 2022, that wasn't that bad of a contraction. Employment kept growing. We kind of sailed through that. And that's consistent with this little tiny dip, overall that economists are expecting, a fairly mild contraction. Let me show this to you in a different way, which is on a year-over-year basis rather than on a quarterly growth basis. On a year-over-year basis, if we get these quarterly growth rates, here's what year-over-year growth looks like. And this means that by the first quarter of 2024, the economy is only 0.5 percentage point smaller than it is in the first quarter of 2023, right? But what's the counterfactual? The counterfactual is that the economy would have kept growing, but for this mild contraction. And that means that we're about 1.9% off of where we would have been. So whenever someone says like, oh, look, we expect a mild contraction, it's saying, oh, we only expect about 0.5 percentage point below zero, right? The economy contracted 0.5 percentage point. But if the economy normally grows 2%, right, then we failed to grow plus we contracted. And that's what feels crummy, right? It's kind of like a shark that has to swim to stay alive. While we stopped swimming, we actually moved a little bit backwards. And so it's a little bit more painful. Putting this in dollar terms, between the no recession and the recession scenario, if we go along the no recession scenario, the economy keeps trudging along and growing at a slight slowdown, but a decent clip. In the recession scenario, the economy contracts. By the time we get to the first quarter of 2024, the economy is $384 billion smaller than it would have been had we just kept on growing, right? So to put this into perspective, why is this so hard to forecast, right? Whether or not we're going to go into a recession. Because consumers still have about, depending on how you calculate it, anywhere between $800 billion to $1.2 trillion in excess savings sitting in their various bank and money market accounts, right? And that means that consumers are still in control. If consumers say, hey, I feel pretty good about the economy, right? Cardi B actually said something very positive, let me go out and celebrate and spend, right? Then that keeps fueling the economy. If consumers start retrenching, then it's harder to sustain the consumer spending that prevents us from going into a recession. So think about it this way. The difference between the forecast is 384 billion, but all of us collectively as consumers have anywhere between 800 billion to 1.2 trillion excess savings sitting in our bank account that if we feel like using to take nice vacations or to buy nice stuff, we can use it and keep the economy afloat. So let's talk about personal consumption expenditures, right? The economy, right? This is the overall economy. It's made up of 4 components. It has government spending, which we don't expect to be all that different between the recession and no recession scenario. It has personal consumption, the biggest chunk of the economy, right? About 66% of the economy. We expect this to be mildly different between the recession and no recession scenario. But here's that mild difference. In the no recession scenario, consumers keep trudging along, they keep on spending, they keep on traveling, they keep on coming to conferences. In the recession scenario, they sustain a high level of spending, but it's flat. It's flat for all of 2023 and into the beginning of 2024, and then it starts growing again. So it's not as if our spending is increasing, we just sustain our current levels of spending, right? So we take a breather in terms of our spending growth. The big difference, so we talked about two things already, government, personal consumption. Let's go into business investment, which is also going to include residential household investment, right? So in business investment, here's where we see a dip, right? Businesses tend to be pretty interest rate sensitive, which means if it's costly to borrow, you're not going to go out and build a factory. Also, if you're a little bit uncertain about whether or not consumers are going to be consuming, you don't need to build that factory. If you look at the difference between the levels of personal consumption expenditure that we forecast, by 2025, if we are in the no recession scenario, you need to have invested to sustain this higher level of consumption. In the recession scenario, you don't need to have built that extra factory to sustain that extra level of consumption because there's still a gap by 2025 in what consumers are spending, right? So businesses react to this, and businesses either say, look, I'm going to keep on investing in building factories and buying equipment, or I'm going to cut back, right? I don't need to be building this factory because consumption is actually going to be a little bit lower than I expected it to be, right? And this is the main driver of the gradual recession that we are expecting in the recession scenario, is that businesses are cutting back on investment spending. So let's move to the Federal Reserve, right? The Federal Reserve says it's data dependent, which means it's looking at what's going on in the economy. It's not trying to make a forecast of what's going to happen in the future. Given the absence of data, it's actually trying to take data that's coming in and saying, all right, given what today's data is, what do I expect the economy to be, right? So what a data-dependent Fed means is that, it's as susceptible to misinformation as all of us are, because it's going to look at the CPI number that comes out next week, which might be subject to revisions, and say, does this tell me that inflation is slowing down or speeding up? It's going to look at this blockbuster jobs reports that we just got and say, does that mean that, the labor market is still very resilient? And so there's a risk here that as the Fed is digesting this torrent of incoming data, that it might actually get things wrong, right? So in the recession scenario, the torrent of incoming data suggests that the economy is still pretty resilient, and it suggests that inflation is a little bit higher than we would like it to be. And so the Fed has to keep increasing interest rates. Right. And so in that scenario, it takes interest rates up to 6.0 to 6.25, so 6.1 being the midpoint. But then it starts cutting a little bit sooner because the economy starts weakening. In the no recession scenario, the Fed takes it from 5.5 to 5.75, so 5.6 being the midpoint, keeps it at that level for longer, and then starts cutting. That's the only difference in the Fed funds rate, right? It's going to be this roughly 50 basis points between 5.6 and 6.1, right? So not a huge difference, but in response to different incoming data. So another thing to consider here is, what's going on in the financial sector. So Jay Powell made this comment. We're looking at what's happening among the banks and asking, is there going to be some tightening in credit conditions? And then we're thinking about that as effectively doing the same thing as rate hikes do. So in a way, that substitutes for rate hikes. Right? This is really important because if you think about, the poor Federal Reserve, it has a lot of things happening at the same time, right? There's very messy data coming in, right? Data is seasonally adjusted. And what seasonal adjustments mean is that, normally in, October, we tend to buy more candy because it's Halloween. And then in April, we tend to buy more candy because, it's Easter. And in summertime, we tend to travel a little bit more because kids are out of school. So there are these typical behaviors that we have as a society. And as long as we're behaving typically, the seasonal adjustments work great. But suddenly, if we're not going into the office and we can, work from anywhere and we can travel to, Palm Springs and spend a few months in Palm Springs and, consume more travel and leisure and hospitality while still maintaining our work, if, somehow seasonal factors are no longer quite at play because we're not doing the binge and purge of hiring leisure and hospitality workers, right? There tends to be the seasonality where you hire a ton of people in December because of Christmas time, then you lay them off in January, and then you gradually start hiring again in May and June because there's going to be a lot more leisure and hospitality consumption over summer. If we're no longer having these swings, it makes it really hard to interpret the seasonally adjusted data. So the Fed is taking all of this data that's behaving a little bit weirdly, and it's trying to make a decision on monetary policy. And then come Silicon Valley Bank, Signature Bank, First Republic, and the tightening of credit conditions. And if you're a bank right now, you're saying, I do not want to be those three. So let me make sure I tighten my lending standards. I make sure I have enough cash on hand. I don't make new loans. And that complicates the Fed's job even further, because the Fed can either raise interest rates to get all of you to stop taking out loans and spending, or banks can say, hey, I'm not going to lend to you because I need to make sure I have enough cash on hand in case there's a run on my bank, right? Or to prevent a run on my bank. So when we talked about this 6.1 and this 5.6, one of the key factors here is that the Fed doesn't necessarily have to go to 6.1. Maybe the Fed stays at 5.6, but credit market conditions tighten sufficiently so that it's as if the Federal Reserve is at 6.1, right? And so the Fed Reserve has a little bit less control over this credit tightening that's happening in the financial sector. It has to take it as a factor that's happening in the economy and react to it. And so the Fed Reserve is in a difficult situation to try to get this exactly right. In the recession scenario, right, the Fed doesn't get this exactly right. And the unemployment rate goes up from the current 3.7 or so that it is today, all the way up to 4.5%. And it goes up pretty rapidly over the course of this past year, right? Or this next year. In the no recession scenario, you still have labor market slackening. The economy is still slowing down a little bit from the pace that it's at currently. And you get slowly up to 4.2% by the end of 2025, right? The Fed has actually been saying over and over again, this is an unhealthily tight labor market, right? There are too few supply of workers, too many job openings per unemployed person. And they're actually trying to slow down the labor market so that wage growth isn't as fast as it is, which would then allow inflation to slow down. All right, so now let's talk about inflation. In the recession scenario, inflation is a little bit higher in 2023. And that little bit higher, that red line being above the green, is the reason that the Fed sees this as an opportunity to continue tightening. Strong labor market, but high inflation. The Fed has two mandates: price stability and full employment. It's not doing too well on the price stability right now. It's doing great on the full employment. And so, it will tighten a little bit more there to actually get it, some more balance. So higher interest rates because we're seeing higher inflation. But then demand falls, businesses invest less, consumers pause their spending. And so in the recession scenario, we actually get lower inflation by 2025 than we do in the no recession scenario. Last couple of points that I want to bring up is what happens to the housing market. So the housing market is also behaving very interestingly. A lot of people locked in, 2.75% mortgage rates. They're not willing to sell their homes. As Ed Leamer has pointed out in some of his writing, the sellers are not going to be willing to sell for less than their neighbors. There's a psychological factor when your neighbor sold their house for price X, if you now have to take a 10% haircut on that price. And so given that people are paying 2.75 fixed rate mortgages that they locked in during the pandemic, people can just hold on to their homes until there's enough demands that they're actually selling above what their neighbors sold their homes for. And what that means is that supply is actually getting reduced. And if supply is getting reduced, then housing prices don't fall by quite as much. Builders still build. This is kind of like a game of musical chairs. The only way that you get people to move around the chairs is if you add more empty chairs so that more people can move around the chairs, right? So builders have an incentive to build more housing because you're still so supply constrained on available housing for buyers. And so in both scenarios, we actually don't see that much of a contraction into the 900,000 units that we saw during periods following the Great Financial Crisis. We're still at around 1.4 million housing units being built throughout the US every year. And it's a little bit higher in the no recession scenario because interest rates are a little bit lower. Consumers are willing to go out and take the risk of buying houses. They're not worried about losing their jobs. So there's more demand for home construction. In the Great Financial Crisis, we saw this 27% peak to trough decline in home prices. Right now, we're expecting about a 5 to 8 percentage point decline. If you look at some measures from Redfin housing data, it already looks like we've reached the trough. Maybe we're going to get a different trough later on in time, but housing prices have started to stabilize and go back up across the U.S. So it looks like we've gotten out with a 5 to 8% peak to trough decline so far. We don't expect this to be anywhere near the magnitude of what we saw during the Great Financial Crisis. I know in the back of your minds, a lot of you are thinking about commercial real estate, what's happening to all those empty office buildings. And I'm going to punt that question to my colleague, David Schulman, who will be able to talk about this during his segment. So with that, thank you very much. This is our US forecast.
Thank you, Leo. Is this on? So Leo told you that in the recession scenario, people stop coming to conferences. Don't stop coming to this conference in the recession scenario. But both Leo and Ed talked about the impact of interest rates, and also how for now, this is the third conference in a row, we've said there's a lot of uncertainty out here, and we've had two scenarios. And in Professor Christina Romer's American Economic Association presidential address, she presented evidence that the impact of monetary policy is about 6 or 7 months to a year. That year will be right about the time of the next conference, so we hope to only have one scenario then, that this will have resolved itself, whether or not the tailwinds are sufficient to overcome the headwinds. But that's going to be really the subject of my talk on the California economy. The last 4 recessions, California did much, much worse than the US. Question is, will that happen in our recession scenario here? And so our roadmap for today is we're going to talk about employment first, where we are in terms of employment, and then we're going to go to some important sectors: manufacturing, leisure and hospitality, and tech, and from there to housing. So we're going to have some focus on interest-sensitive sectors and finish with the forecast scenarios. And then after that, I'm going to tell you what we 4 plus David, our forecast economists, think about these two scenarios and which one is more likely, if any are more likely, but you have to wait for that. Let's talk about California and employment. The graph you see here is non-farm jobs in California, dropped by 16% in the great financial crisis. And then in this last April, we found that we were 2.1% above the previous peak. So in spite of what you heard about everyone leaving California, if you drove in on the 405, this is why. We have more employment than we had before the pandemic. And where is that employment? Well, it's spread unevenly. It's still spread unevenly. If you look over on the right-hand side where the red circle is, you're going to see leisure and hospitality, other services, retail and wholesale trade. These are sectors that have not recovered. And so we're still missing jobs there. But if you look on the left-hand side, we've got a number of sectors here. This is logistics, and that's been one of our real growth sectors. And then we have 2 sectors here that represent tech. Now, tech is spread throughout all sectors. There's no real tech sector. But the larger one there is professional, scientific, and technical services. The smaller one is information, but that includes Hollywood and telecommunications and newspapers and the like. But those have both been growth sectors. This one might surprise you, durable goods manufacturing. So we're going to talk about that a bit and what's happening with manufacturing in California, because as Leo pointed out, that's something to look at to see which scenario we're going to be in. It tends to be nationwide interest sensitive. So let's look across California in the different regions. The light green here is the US growth rate in jobs this year. And the darker blues are the different regions in California. Almost everywhere, job growth has been at a faster rate than the US and California. As you move to the right of that light green, you get Silicon Valley. But it's just about the same as the US, it's a little bit less. And then you get the Inland Empire, which benefited a lot from the growth in logistics, but has other issues right now. And of course, all the way over on the right is the great state of Jefferson, which is both losing population and jobs. Now, looking at the same time period, so this is so far this year by sectors, and here we have durable goods. Lost some employment in durable goods. We're going to dig into that. But here are our 2 tech sectors. The information is over on the right, lost a few jobs there, but but professional, scientific, and technical services still growing this year. And then here is logistics. So what's happening in the Inland Empire is apparently not logistics, probably manufacturing. So we're going to jump into that. All the way over on the right, all the way over on the left is leisure and hospitality. So that was a sector where we haven't fully recovered, but we're adding a lot of jobs. So the first question we want to ask is, where is the pain and what's going to happen if we dip into a slow growth or recession scenario? And you see that here. So this is the geography of job gain or loss this year, this last 12 months in leisure and hospitality. And the negatives there are on the left. That's the Bay Area. So that's two reasons. One is there are more jobs in the Bay Area that can be done remotely or with hybrid, so people aren't coming into the office. And the second is the Bay Area is a big tourist attractor, particularly for international tourists, and particularly tourists from China. So when the tourists from China come to the US, they go to Los Angeles, they go to San Francisco, Las Vegas, and New York. And because of zero COVID policies, they haven't been coming. If we get a softer economy, we're going to have some tailwinds in leisure and hospitality because now that zero COVID is over and the US government is working through the visa issues, we're going to get more Chinese tourists. So that's going to moderate what happens in leisure and hospitality in California relative to the US average. Doesn't mean it's not going to shrink, but by not as much on a percentage basis. Now let's turn to manufacturing. And the graph that you see here in manufacturing is manufacturing employment. And you can see the little dip at the end. But look at it. Manufacturing employment in California is higher than it's been in over a decade, and it's been growing. And the interesting thing about this, and this is important for our forecast, is what's been happening. So the graph that I just put up there is productivity growth in manufacturing, recent productivity growth in manufacturing. California is all the way over on the left with outstanding productivity growth. North Carolina is all the way over on the right with negative. It doesn't mean that the people in North Carolina are going to factories and jumping on their phones and playing on Facebook or TikTok. What it means is that the expansion in manufacturing in North Carolina is manufacturing that has lower productivity of labor than the average. And that what's happening in California is that lower productivity manufacturing is indeed leaving. And the growth is in higher productivity manufacturing. And so you can see that in that, that dip in employment in manufacturing by breaking this down by what kind of manufacturing. So on the left-hand side, you see furniture, you see metals processing, you see minerals processing, and those are negative. On the right-hand side are semiconductors, navigational devices, computer peripherals, and the like, the high-tech manufacturing. That's where you get this increase in productivity. And it's not that California workers are working much harder and not on their phones. It's a change in the composition. And we can see the change in the composition and how that's going to affect us going forward just with some anecdotal data. I'm going to show you 5 pictures here of manufacturing in California. And so the upper left is in Hayward, a new factory to build advanced charging stations for electric vehicles. And the next two are in the Central Valley. The first one is Bosch. Bosch has purchased an old factory in Roseville, and they're spending $1.5 billion to produce semiconductors in the state. And in the Tesla in Lathrop in the Central Valley. Now, Tesla has factories in Nevada and in Texas. They're building a big factory to build batteries in the Central Valley in Lathrop. And then in Southern California, we have Northrop in Palmdale with their new factory to build the B-21 aircraft. And we have this, and this one is I find particularly interesting on the lower right-hand side, Scorpios. Scorpios is a Texas company. They manufacture semiconductors. They're closing their Austin factory and moving it to Temecula and expanding it in Temecula. So when you think about this and think about the industrial policy of the US, the Infrastructure Act, the CHIPS Act, and so on, those things are not as interest sensitive. And defense spending is not interest sensitive. And so this is going to moderate the impact of either the slow growth or the recession scenario in California. And for defense spending, this is just a list of states that are receiving defense expenditures. And you can see that they go to very few states. And California is number 3 on this. And the states that are really doing defense manufacturing extensively, Texas, California, Connecticut are all up there as the top states. So all of this means that disproportionately, whatever impact interest rates have on manufacturing is going to be less in California. Okay, so turning to tech, and we've heard about the tech layoffs. This is employment, payroll jobs in professional, scientific, and technical services in the state. Even if you squint, you can't find those layoffs. They're not there. What's happened is the layoffs have happened. People have been rehired, but they're being rehired by smaller tech firms that no longer have to compete with the big salaries of a Facebook, a Google, and so on. And so salaries are going down. That affects consumption in the state because there's deferred income in these startup firms. But venture capital is coming back to California. The first quarter of this year, venture capital is up relative to a year ago. And 60% of that is coming to the state. And now there is even more of a rush of that because of not just green tech, but AI. And in fact, there was an article in today's New York Times about the boomerang effect that these tech entrepreneurs who had moved to, there was an example for Bend. Bend is great to live in, but I don't want to miss out on the AI revolution and moving back in. So this is going to actually support the tech industry in the state. Okay, let's turn to housing. In housing, and Leo talked about prices in housing. In California, the median home price has dropped here by 8.4%. But that's the median price, right? So where half the houses that sold were above that and half were below. And so there's compositional effects. And the fact is, not much of anything is selling, right? That $200 million house in Malibu that Jay-Z and Beyonce bought, it doesn't really affect this, right? And so what we have is a real shortage of housing in California and not much being put on the market on existing family homes. And so what that's done, in combination with a series of 6 bills passed by the legislature, 6 bills that overrode local zoning, the impact of interest rates on housing construction in California should be less. So let's look at the data. The left-hand graph is 2022, and these are permits for new construction. The blue is California, and then you have the orange are other states. Almost no change between 2021 and 2022 in California. And the right-hand side is so far this year, the first quarter of this year. And what you see is California is indeed contracted. We're now at about a 97,000 unit run rate, so that's pretty low. But nevertheless, the contraction on a percentage basis, less than the rest of the US. And when you think about this, kind of why and how do these bills really feed into this? 20% of all new home permits in Los Angeles County were for ADUs. So that's a new home, a less expensive home, and that's a direct result of these bills. And the other thing to think about is, well, you know, we used to build a lot of single family homes. Are we doing that now? So this graph shows you single family housing permits as a percentage of total residential permits. And we used to be up at about 70%. We dropped to about 50%, and that's where we're staying. Now think back to that manufacturing. Where was the growth in manufacturing? Central Valley, Temecula, Palmdale, places where land is less expensive, and we're getting single family home building in those areas. So we're getting both single family and multifamily and ADUs throughout the state. So that brings us to everyone leaving California. This is a spaghetti diagram. It compares the premium that California housing used to bring in 2015 compared to what it's bringing now. on a city pair basis, a kind of donating population city to a receiving population city. And for most, even with the falling prices in places like Phoenix, you find that 20 to 30% drop in that premium, which means that if you sold your house in 2015 and bought a house in Phoenix in the same year, and you did the same thing this year, you get only 80% of the amount of housing you received before. So there's less incentive to do that. And so that leads us to a population loss forecast, which has that diminishing over time, not going to zero, but diminishing over time. And just as an example, if you were to buy the median home in Sacramento today, you'll pay less than you will for the median home in Boise, Salt Lake City, Phoenix, Austin. So that price advantage that these cities have had, and of course they complain that we, meaning those Californians who left, did this, that price advantage that they had is pretty much gone. Not compared to San Francisco or LA, but certainly compared to Sacramento. Okay, so that kind of brings us to the end of the California forecast. And what are the things that make it different from the US forecast and lead to the conclusion that it's going to be more mild if it's a recession, maybe not even a recession at all in the state. If it's a slowdown in growth, the green line that Leo showed you, not as much of a slowdown as the US. One is leisure and hospitality, waiting for the Chinese tourists. In manufacturing, there's high-tech manufacturing and defense and aerospace that's less interest sensitive than manufacturing in general in the US. Tech with AI, now the new darling of the VCs. Construction, the new housing laws, and we're going to talk more later in the program about industrial building, but factories are part of industrial. So we do have also some tailwinds in construction. And we haven't talked about government. The state has a big rainy day fund. Right now, the discussion between the governor's office and the legislature is, do we dip into it? And the question that is being asked is, why do we have a rainy day fund if we don't use it when we need it? And the governor is saying, we might need it later. So it remains to be seen what happens there. In terms of most local governments in California, Prop 13 has provided a very stable tax base. And in fact, those increases in home prices we've seen over the last couple of years means that the tax receipts from property taxes for most localities in California, San Francisco certainly accepted, is going up. So from a governmental expenditure basis, California is at least as well off as the rest of the nation, maybe better off. So that brings us to a few numbers. So this is job growth. R means recession. It's not the software program. No R means no recession. And so in the recession, we have a dip in employment gain. On a quarterly basis, we get some negatives. But on a yearly average basis, drops to base of just about zero between 2023 and 2024, then growing back in 2025. In the no recession scenario, we maintain pretty good job growth. And you see the impact of that on the unemployment rate, that in the recession scenario, unemployment goes up to 4.8%, and then drops only to 4.6% in 2025. But in the no recession scenario, it stays down around 4%. And so that brings us to the end of California, but we want to ask one more question. Which scenario? So we polled each of the five of us and said, give us your probability of a third quarter recession, which is our recession scenario. Not a fourth quarter recession, not a recession sometime, but the third quarter recession, which is our recession scenario. And then just took a straight average of that, of those numbers, and came up with 42% probability of a recession in the third quarter. So that is even worse than flip a coin, right? That is probably not a recession. In fact, we have 58% probability that yeah, there will be a recession sometime, but it's not going to start in the third quarter. But there's still a great deal of uncertainty. And just to emphasize that, we've been doing this poll for the last 3 conferences, and the differences amongst the 5 of us have gotten wider. So there's a lot more uncertainty about this. And so that brings us to the conclusion of the California forecast. So thank you. Okay, so now we have time for some questions. Okay, so we have a question here.
Comes to the management tax, some people are saying that less people are gonna sell the expensive homes, so the property tax won't get adjusted to the higher sales price, so it'll actually decrease revenue to the state versus increase revenue.
So the mansion tax question is, what are our thoughts on the mansion tax? I actually wrote an article on that that's published in by the Ziman Center. And my article relates to commercial properties, which the mansion tax actually applies to as well. The mansion tax is a transfer tax in the city of Los Angeles, which has 2 tiers, one for 5 million and above, and the other for 10 million and above, which means it applies to almost all commercial properties. And what you suggested is right. You're going to have a postponing of the sale of properties or repurposing without selling. And the interaction between the transfer tax and Prop 13 is what actually is going to drive lower revenues rather than higher revenues. Because if you don't sell that property, it doesn't get rebased. And so that also applies to residential properties. And we don't know if the softness that we've seen in prices in high-end residential properties relates to the mansion tax or just to general market conditions. But certainly the evidence seems to be that likely the sum total of property tax and transfer taxes will go down because of. Okay, we have another question. Yes.
What keeps manufacturing in California?
Oh, this is a great question. What keeps manufacturing in California? I've asked manufacturers that. And I'll give you the last one. A manufacturer who is building right now a factory in the city of Orange. And I said, why are you doing this? This is Orange County. You've heard of this place called Texas, right? And the answer was, yes, but this is where the talent is. You have the University of California system, you have the Cal State system, you have our 100+ community colleges, you have the private schools churning out the talent that they need to operate and grow, and you don't have that anywhere else. And that's the answer that we hear over and over again. Yeah. Yes, and you remember what I showed you on the productivity and how the composition is changing? So if you don't need that talent, to your point, there is this place called Texas. But if you do need that talent, the pool here is really deep.
How much of, or if any, have you looked at the implication of, the social changes in some of these cheap states like Florida and Texas, where like Disney said, I'm not moving 2,000 people to Florida because I don't want those people to be subject to the social situations that are in Florida? How much is that going to impact going forward? The willingness of people to leave California to go to these cheaper states that have a more draconian social environment?
So we have no data on that. I don't know if you all want to comment on this.
Yeah, really.
I mean, we've seen a sorting of people by political philosophy, over the last decade, certainly. How will this play out, kind of over the next 5 years? We don't have any data to really answer the question. The question. Yeah, Ken.
Talk about the longer term impact of demographics and labor force participation. I think there were a lot of people, right, who just dropped out of the labor force as a result of COVID, retired early, et cetera. So how much is that impacting resilience that we're seeing in the employment rate?
Leo,
So we are at some of our best numbers that we've seen in a decade since the financial crisis in terms of prime age labor force participation, right? So this is going to be people up to age 55, right? And so this part of the economy is doing really well. We're seeing the lowest unemployment rate and one of the highest participation rates for Black American workers, for Hispanic workers. It's at the older age groups where you're seeing lower labor force participation, where people have retired. And these are baby boomers that had stayed into the labor force until they were 65, 66, 67, 68, who have retired during COVID and who don't seem to be coming back. So that's still where the gap in labor force participation is. But from prime age labor force participation, we're doing spectacularly well.
I think one important aspect of this is what's happening with immigration. So this year, immigration numbers are up, but does that continue? And I think that's an open question.
So I would add to that you're asking, is the future going to be different from the past? And does COVID-19 contribute to that in some way? I really think we're moving into a post-industrial world, and the historical data from the United States was mostly about industrial cycles and not about the post-industrial and electrical cycles that have come next. Our employment in manufacturing, which was about 35% in the 60s, is down to 8 or 9% now. So that's not going to be a contributor. There's going to be a totally different kind of economy going forward.
Can you speak a little to if there's a correlation, and if so, what correlation you see between the type of unemployment jobs that are coming versus consumer spending? So is the unemployment in lower wage workforce, higher wage workforce, are those the people that don't have savings that would then affect consumer spending? Is there any type of correlation to that, or is that unemployment rate nuanced based on the type of job?
Yeah, so Leo, why don't you talk about wages?
Yeah,
by,
so-
by
So the
category.
lower end of the wage distribution is doing better than the higher end, in the sense that this is where we're seeing a lot of growth, right? So we're seeing growth in leisure and hospitality jobs, in manufacturing jobs. This side tends to be doing okay. And that wage growth has actually been faster than the rate of inflation for lower income households. At the higher income household end, there's been a little bit of a struggle, right? Because we saw a lot of overhiring early in the pandemic in things like tech and professional and business services. And so you've seen some cutting back at that higher end of the distribution.
So I would add that when we moved those manufacturing jobs overseas, we destroyed the value of a high school education. All those people, particularly in the Middle West, who had histories of jobs in manufacturing, that's all gone now. And I don't think there's anything that's really replacing them. At the other end, the tech sector is emphasizing those people who have the talent and education. And if you have that, then you're going to be in the future extremely well off. And I really think the other 90% of Americans are going to be struggling over the next several decades.
Although with one caveat, I saw this great billboard that said, ChatGPT cannot replace construction workers, right? So, there's still going to be this sector of jobs that have to be done, manually. And there's demand for, this type of labor. There's the demand for the leisure and hospitality worker. And that seems to be fairly resilient.
Yeah, and the industrial policy that we have today, that's bringing back advanced manufacturing. So I think the real issue, and this speaks to the point that Ed was making, the real issue is one of educating the next generation so they can take those jobs. And those will be higher wage jobs. But the incoming population has to have the skills.
Well, I would add you have to change the educational system too, which is mostly historically about memorization. The instructor would give a lecture and then you'd be examined at the end of the quarter or the end of the semester to see how well you memorized. Memorization is way better on a computer than any human being could ever be. So we need to create in our educational system the ability to be creative problem solvers, and that requires much more labor-intensive education. You have to have one-on-one conversations with these students about vague things that even you don't understand, but between the two of you, you make some progress, and then they understand how to make progress when they graduate.
We have a question over here.
Yeah, you talk about a couple major thing about the talent being a reason manufacturing are staying here or coming here. Another thing is the limited, you expected very limited correction in housing price. What is your view on long-term implication and lack of affordability compared to other emerging cities that are trying to create, replicate what we have in Silicon Valley or here?
Yeah, so what we've seen is that unaffordability of California, we've exported it. We've done a really good job exporting it. And so you no longer move to Austin for housing reasons. You move to Austin for a lot of reasons, and Austin's a really nice city, but you don't move there for housing affordability reasons, right? When you can live in Sacramento for less, and you have all of sort of the physical amenities, you're close, relatively close to the ocean, but certainly close to the mountains, you have better weather and so on. So that premium has shrunk, and the affordability issue in that sense is going away. Now, could Farmington, Minnesota pick up the baton? Maybe not.
So I would add to that, Raj Chetty from Harvard has shown that these maybe zip codes or census tracts, if you were born in that census tract 50 years ago, your prospects were very, very low, and finding a home would be difficult. That census tract, 30 years, same place, 20 years ago, 10 years. So we've had these consistent census tracts where the intellectual potential of these kids is just wasted. It's like a resource, like oil, that we're allowing to not to be used. So I think we need to, as a culture, we need to focus energy on these left behind census tracts and make sure that those kids are going to get educated and have them filling up UCLA's classroom with a different kind of group of people.
Yeah, and that would be a kind of spreading the wealth. We have time for one more question. Do we have a question over here? Because we've right there.
I see so much innovation. I see so much innovation just among small businesses on a daily basis. And I'm just curious, do we have any data on the growth in number of small businesses, and then also their contribution to the economy as well? Because I feel like it's just popping up everywhere with AI. My clients who are doing electric vehicles are killing it month over month right now. I mean, there's so much happening.
Yeah, so that's a great question. And that's why the last economist in our row here, who I think I neglected to introduce, Dr. William Yu. William has been with the forecast for a little more than a decade, received his PhD at University of Washington, and has been studying this in a project with GoDaddy. So William.
Yes, that's a great question. In 2021, we started this index, we call it Micro Business Activity Index. So you can find the index through our website. So what we found is we had these 3 sub-index in terms of infrastructure, in terms of engagement, in terms of participation, and mostly is online small business. So what we found is the state or local area with higher human capital and higher digital infrastructure, for example, the access to broadband and computer, had a better these micro business, small business participation. And what over time in the nationwide, we find you can see this kind of high rise because we started to trade in April 2020. So there's a higher participation, and that's kind of consistent with the whole small business in the nation because of lockdown pandemic. So both the small business turn their business online, otherwise they cannot survive. So we see that those kind of rapid rise in 2020, and it went down. However, in 2021, 2022, through this kind of fiscal stimulus recovery, we see this kind of a strong engagement, meaning there are a lot of activity online with this small business. However, it peaked in April 2022, and it went down through today by and large. And we think the reason is because it also got impacted by the Federal Reserve's interest rate hike. So those kind of business got impacted.
Okay, so that brings us to the close of this part of the program. And what we're going to do is take a 10-minute break, time to stretch your legs and get some coffee. Then we are going to do a deep dive into what's happening in commercial real estate with higher interest rates, higher cap rates, and of course, the office. So we'll start again at 10:30 prompt. Okay, for this part of the program, we have three segments. The first one that we're about to begin is on the latest results from a survey of commercial real estate around California. Then we're going to invite David Schulman up here to talk about, not yet. David Schulman will come up and give some introductory remarks on finance and commercial real estate. And then we have an amazing panel on commercial real estate, which will be moderated by Professor Stuart Gabriel. So let's begin with the survey. On. Great. So joining me to talk about the Alan Matkins UCLA Anderson California Commercial Real Estate Survey is John Tipton. John is a partner with Alan Matkins. He studied at Miami University, Miami of Ohio, right? And earned his Juris Doctor at Harvard University, has been with Alan Matkins a fairly long time, and certainly the entire length of the time we did this survey. John was one of the first people I met when I came to Anderson to talk about what we're going to talk about today, which was 17 years ago. John has deep experience in complex real estate transactions, from office to property to retail and so on, including, just to give you one illustration, a $9.5 billion transaction involving the old Hughes Aircraft Company. And we're going to talk about the latest survey results, which are hot off the press as of last Friday. But to start, we've been doing this now 16, 17 years. And I think maybe it would be useful to just kind of hear from your perspective why Alan Matkins was interested in this. What is this survey about? And kind of, where do we go from here?
Sure. Thank you, Jerry. Appreciate that very much. And good morning to everyone. We met with Jerry in the Anderson Forecast back in 2005, 2006, and collectively agreed there was a little bit of a hole in the predictive data that was out there. And so working with the forecast and many of our clients, we came up with this survey and index, which really from a developer's view was kind of taking a 3-year outlook. The time that was generally deemed to locate a project, get it under contract and close, secure entitlements, line up your financing, build it, and God willing, the money starts coming in. And so overall, I think it's been a pretty good predictive tool. Jerry did a retrospective of it at our 10-year anniversary. And like everything else in human existence, it's not perfect, but it really was, it held up pretty well under the retrospective analysis. So jumping in to our results this year, and I guess this might be under the heading of taking your medicine first. Jerry, when I look at the office sector and we think back to when were things this bad potentially, 2008 comes to mind. Mm-hmm. How do you think the survey for office, and what do you see now relative to 2008?
Sure. So let me put up some charts, and I think I need the clicker to do this. So we're going to show you the latest results over 4 different spaces in commercial real estate, and the charts are all going to look like this. So let me describe this chart first, and then John, I'll come back to your question.
Sure.
So this is for the office market, and we have our 8 markets in California that we survey. You'll see that some of them start later than others because as you build a survey, you keep adding to it. But these are the 8 major markets in California. And each market has a different color. This is a sentiment survey, which is a composite of our panelists' views of vacancy rates and rental rates, looking out at that 3-year horizon. And that was kind of one of the interesting things that I think we came up with in our early discussions. What is it that we didn't know? And where can we fill in some of the information for professionals in the field? So the dash line here is at 50. And above the dash line means that a majority of our panelists were more optimistic about the economic status of labor markets, of office markets 3 years hence than today, and below 50, pessimistic. And so you see it moves around a lot, but I want to show you now in answer to your question. This is, we have the red line and green line here. The red line is rental rates, and the green line is vacancy rates. And you notice that the one that's 2008, 2009, which is kind of the one that you referred to, John, steep drop below that dash line. Very pessimistic. And what we saw from this, maybe not a big surprise, but what we saw was that it was highly correlated with the development of new office space in the next 3 years. And then we get kind of a return of the office, and then the pandemic hits. No one knows what's going to happen to the office. We're working from home. We go back down to that, and we see the winding up of existing office construction. Then people start coming back to the office, and we get kind of this little spurt of optimism, but not much. And now we're back down to, we don't know what's going to happen with the office. And because we don't know what's going to happen, we're really back to that 2008. So the predictive tool here says that don't expect much in the way of new office development over the next 3 years. And in fact, our panelists have not entirely, but almost entirely moved themselves to the sidelines. So now if we go back to this original chart, you can see in each of these markets, the one that I showed you was for Los Angeles. That was the first market we did. So in each of these markets, you see it drops down and it stays down. And so that is a very pessimistic view of office development. Again, it's not much of a surprise, and our panel is going to talk a lot about sort of the what's going on with boots on the ground with that. But from your perspective, what are you seeing? We know that there's stress in the office market. Are there more office deals, or are people just waiting now?
Right. Well, I will tell you, our law firm is actually surprisingly busy, but not in office commercial transactions, capital transactions. They're very, very limited. I mean, within the city of LA, you do have the overlay of ULA, the mansion tax, as you all were talking about earlier, but that's just Los Angeles. And really firm-wide, and we're throughout California, they're very, very limited capital transactions. You have limited demand for office space. You have a quite robust sublease market. And it is not a case of kind of, hey, if we just drop rents by a nickel or a dime, I'll be able to lease up my building. That demand is not there right now. And so, as opposed to 2008 and 2009, where really loans got kicked down, 2, 3, 4, 5 years, and money was basically zero. Money for anyone who's looked to borrow money recently is clearly not at zero. So something is going to have to give. The real estate market is not like the stock market. I mean, it doesn't move on a dime. It's not illiquid, but it's a chunkier industry. So this is just starting to play out. Certainly our asset resolution group is getting more calls, but it's really, I don't know if it's the tip of the iceberg, but it's just, maybe it's the tip of the spear. And so that is going to increase for better or worse. When I look at office now, Jerry, it reminds me a little bit where we were 4, 5, 6 years ago in our survey talking about retail. And everything was just negative, negative, negative. And as I look at our current results for retail today, it seems to be a little optimism. So what are you seeing there?
Yeah, so retail is, I think, the most interesting part of this. And we're very fortunate in our panel. We have Jackie Levy from Caruso, who's going to talk about their perspective on retail. But from our developers, what we're seeing, and there's the same chart, but for retail across California, we're really seeing a return of optimism, except in San Francisco and the Bay Area. And we talked about the reasons for that in the California forecast. But what seems to have happened in retail is that excess space, a lot of that excess space is now gone. We have new housing, and new housing requires new retail. And there's also, and this is kind of one of the, anecdotally, one of the manifestations of being locked down for 15 months is we want to go out and be with people. And where are you going to go out and be with people? Well, one is retail. And so we're starting to see, not a lot, but a little bit, a small part of our panelists saying they're going to start developing new retail. And so this market, as you have said, market has been flat for a long time. Now it seems that it's turning. And so maybe it gives us some insight into what's happening in office markets and what will happen in office markets.
Well, that's one of the things, we are a free market. And so the market takes time to work out. And as you said, it's a little bit of all the above. You did have new housing demanding new retail. You have retail that went out of retail stock, and in some cases turned into office or was demolished and repurposed for something else. And then existing retail that just simply got enhanced where people wanted to go. So it is a little bit of maybe it's not a success story, it's certainly a better story than it's been for a while.
Yeah, so we started with office, and our survey is saying don't expect much in the way of office development in California. And then retail, that's starting. And so we sort of started on a low note. Let's start turning to higher notes, industrial. So this is an interesting, we ask a lot of questions besides the ones that give us this, this sentiment index. And what you would see here, if you were just looking at this in industrial, is developers are pessimistic about industrial. But remember what this index is. It says, will markets in 3 years be better than today? Industrial markets today are red hot, right? With vacancy rates in the 1% range for warehouses. And we see new factories being built as well. So the expectation that goes into this is that rental rates are going up, but vacancy rates, they're unsustainably low. And so, what are you seeing in industrial?
Well, I think you're right. You look at this graph here and you say, golly, I thought industrial was supposedly a good, strong area, and it's clearly not. And as you pointed out, the two basic questions that determine this graph, and Jerry asked a lot of other questions in his survey, are rental rates going to go up greater than inflation over the next 3 years? And I think most of the panelists thought they would. But vacancy rates have simply been unsustainably low, 1 or 2%. And what does the market do? Well, it brings on supply when you have that. And so this is the market at work. But when you look at, where are people putting their money? So we have our panelists in Northern California, literally 91% said, I'm starting a new project in the next year. And 60% said, I'm starting more than one project. Southern California, 80% starting a new project, 50% starting 2 or more. So it's still a very hot area. And I think, quite frankly, I have clients who would traditionally be office people. That's what they did. They're industrial people now. I mean, real estate does have a lot of commonalities. Obviously, there's specialization in it, particularly when you get into retail. But people are still putting their money in industrial.
Yeah, I mean, that's sort of the interesting part of industrial. Yes, the vacancy rates are going up from 1%, but not by a lot. And there's still millions of square feet that are being built. One of the questions that we asked is, in your estimation, over the next 3 years, do you think that demand is going to grow faster than supply? And in Southern California, the answer was yes. So a tight market, still we expect it to be a tight market. So that's certainly good news. And then the other market that we survey is multifamily.
Well, and so this is my question for you here, because one thing that just overlays certainly all of real estate, all of the economy, but real estate is particularly an interest rate sensitive industry because it's traditionally a leveraged industry. That's how the model works. So what are our panelists seeing now, and how much has the interest rates turned them pessimistic, if at all?
So if we look at their sentiment, we saw, each block is a survey. The survey is done twice a year. And the block all the way the furthest to the right for each of these markets is the one that just finished. To the next one to the left would be the winter survey. And, so there was some fall off in sentiment amongst developers of multifamily housing when interest rates are going up. Now they've said, the market is sufficiently strong that we're back, and that, yes, cap rates are going up. Yes, interest rates are going up, but so are rents. And, we can support this building. And just like in industrial space, I think we find a majority of our panelists are going to start one or more new projects in multifamily housing. And in terms of transactions, is that consistent with what you all are seeing?
Absolutely. Other than, again, in the city of Los Angeles, and I read Jerry's article on that. So the markets tend to adjust. And of course, leading up to the mansion tax coming to a case, I mean, there was just a huge spurt, certainly in our law firm, and I think generally for a lot of people, practitioners, of transactions. So people wanted to get it under the bell. Ultimately, that will come up again just because things do have to move over time. But this is still a very favored food group in real estate.
Yeah, so as a consequence of Measure ULA, I would imagine that you are seeing developers of multifamily housing coming to you with projects outside of the city of LA, but still in Los Angeles County.
Sure.
Yeah, because I mean, what we see here is still optimism about Los Angeles County.
Right.
I think if we had asked the question about the city of Los Angeles, we might have a different answer.
Possibly so.
And so those are the four that the four types of commercial real estate that we survey. Kind of overall, what are your thoughts?
No one is immune to interest rates. I will tell you, going back to our first topic, and maybe Jerry and I have a tendency to get the bad news out of the way first because we're both optimists at heart. Some of the smartest people I know in real estate are actually kind of excited about office. I mean, it is a case of maybe them looking for future pleasure from other people's pain. I don't want to deny that. But I think, there will be good opportunities out there. Probably not today. The market needs to work through the process a little bit, but like everything else, things do go in cycles. So don't panic yet.
So this survey, as I said, the results just came in Friday. So it'll take about a month to pull together our monograph, which you can find on the Alan Matkins website. You can find on our website. So look for that coming out early July, and that'll be kind of the complete results and some analysis of those results. Our next survey will be in the winter. And you remember we talked about that 6 to 12 month window from when interest rates started going up. So by the time we get to the winter, we should get some real clarity on some of these markets. So look for that coming next winter. And over these 17 years, it's been a pleasure working with you, John, and Alan Matkins in this survey. And one of the really interesting things for a forecaster is it has great predictive value. So we look forward to another 17 years.
We have
and
certainly
more.
enjoyed our collaboration.
Okay, thank you, John.
Jerry. Appreciate it. Thank you.
Okay, and now we turn to our own David Schulman, and as David is getting mic'd up and coming up here, David spent more than 15 years at the Forecast, had a distinguished career on Wall Street, has his PhD in finance from UCLA Anderson, came back with us, decided he was going to retire, but then we said you can't do that, so he is still with the Forecast. And and one other thing that I want to point out is that David also was in his time at UC Riverside, our sister institution, was a distinguished professor and continues to support now at Baruch College the upward mobility of individuals from underserved communities. So with all of that, David, what's the good news or bad news?
Okay, the good news. All right, let's start with as our friend just said, with office vacancy rates. This is the U.S. office market. You'll notice that vacancy rates now are higher than where they were in 2008, and about the same as where they were in 1990 real estate crisis. And the thing is, this really understates what's going on, because office occupancy, physical occupancy, because of work from home, is you probably have to add another 20% onto that. So the occupancy, the vacancy, if you want to look at occupancy, it is like a 40% vacancy rate, not a 20% vacancy rate. And that is like hybrid work, I think, is here to stay. And I think that's totally restructuring the whole office market right now. And there's an article today in the Wall Street Journal. Farmers Insurance said they wanted everybody coming back to work, and there's a rebellion among everybody. I had lunch with a good friend of mine in New York 2 weeks ago. She's senior managing director at JP Morgan, and JP Morgan told Jamie Dimon told everybody, all managing directors have to show up for work 5 days a week. So she's in the office 5 days a week. She has a bunch of young people working for her. They don't show up 5 days a week. They're not there on Monday, they're not there on Friday. And I talked to say, hey, Kay, what's going on? When we were coming up, if we had a chance to have quality time with our managing director, one-on-one for the whole day, we would be there every day. And these kids, not today. They're not there. So for whatever reason, there's a total change in the whole attitude towards being in the office. And this thing, I think, is this thing is going to continue to bleed. It's a slow bleed that's going to go on for many years. And the difference between 1990 and 2008, then you could extend and pretend loans. You could assume is you get some economic growth. You could refill the buildings. The vacancy rates will come down as they did at other times. And you can make some assumptions that things will get better. I think now we have a whole bunch of office buildings that are basically functionally obsolescent, and they're not convertible. Most of them are not convertible to residential because the floor plates are too big, although my friend Carl might disagree. At a price, maybe they are, but that's a very, very low price. So we have a whole bunch of obsolete buildings. And you could look at downtown Los Angeles, you could look at Park Avenue in New York, you could look at downtown San Francisco. And those buildings are never, in my personal opinion, are never going to come back as office buildings, and never is a long time. All right, okay. The other thing is office, most of the vacancy is in the old. This is a Goldman Sachs source. This is the numbers don't add up with the previous data, but this is Goldman Sachs is most of the vacancy. This is really occupancy here. are in older buildings rather than newer buildings, but the reason is newer buildings were recently leased and older buildings basically are bleeding. Space is going from older buildings to newer space. This is the apartment world. The apartment world has been living terrific. Vacancy rates nationally are just very, very, very low. It had an uptick in the first quarter. In the Southeast, this number is going to begin to rise because we've had huge construction in the Southeast of the United States. There's lots of new supply coming on. So we're going to see occupancies rates begin to decline. Vacancy rates will go up. And actually, we're going to see rents actually for the higher end apartments, rents are actually going to be falling. In many of the Southeast markets, you could talk Dallas, Atlanta, Nashville. You could go, Nashville is a city I'm very familiar with. The state bird of Tennessee is a construction crane right now, and there's just a lot of construction, and rents are going to tend to fall there. But so far, they will still, vacancies will still stay reasonably low. There's alternative measures of rents, and the main thing is that it's a hard chart to read. But if you look at the blue line on top, that's sort of what's really happened with rents nationwide. They spiked up to about 18% year over year. And the bottom lines, which are still going up, that's what the government's reporting. Now, why? The government CPI data is showing rents are up 7 or 8% year over year. The market now is only maybe 5%. But what happens is the CPI measures rents in place, not new rents, on apartment turnovers on new leases. They measure rents in place. And the time series is overweighted by rent-controlled jurisdictions, New York, Los Angeles, Washington, D.C. So that tends to suppress the rental levels that's in the consumer price index. So, but the thing is the bad news is for the Fed is that we've seen a pause in the drop in market rates, or a slower rate of decline in market rates for apartments with the exception basically of New York City and stuff, which means is that apartment rents are going to stay higher than what the Fed wants. And I'll give you an example. Equity residential, which shows 80,000 units, reported that year over year rents are up 6%. Now, if year over year rents are up 6%, that means the Fed has a real problem. It's going to be very hard to get inflation down to 2%. So even if it's 4%, rents are 4%, it's going to be very hard to get inflation down to 2%. So that's sort of an argument that on the rental side, which has been keeping inflation up, is higher rates for longer. Or that's my sense that CPI is not going to get to 2%. And I differ with the official forecast here. I don't think we've got down to the low twos by end of 24, 25. I think if we get to 3%, I think the Fed may declare a victory. The other thing here, if you take a look at what's going on with multifamily construction is you could sort of get a sense of why there's a housing shortage in Los Angeles. You take a look, this is multifamily permits, selected metros, 12 months ended March 23rd. Dallas, 30,000 units, New York, 30,000 units, Houston, 28,000, Austin, 20,000, LA and Orange County combined 18,000. So that's sort of you want to say the core of the problem is this is a big sprawling metropolitan area, and Los Angeles, Orange County has more people than all of those areas with the exception of the New York metro area. Los Angeles is a higher population area, and there's just not enough building going on. As Jerry said, ADUs, maybe 8,000 ADUs, that's a help. But Los Angeles, Orange County, given its should be doing 50,000 units, 50,000 units a year. It's doing 18,000 units a year, and that's the core of that, the core of the housing shortage. And and if that doesn't change, it's not. If you don't get that construction, it's just not going to happen. And you're going to have rents under pressure and more political pressure to do more and more rent control here than compared to, say, Dallas or Houston. For strip malls, there the vacancy rate has stayed high around 10%, and hasn't really recovered. And what's going on in retail right now is what's really working in retail is not so much goods as Leo talked about, it's services. And the hottest thing in retail is restaurants and bars. And if you take a look at the retail data, where retail goods sales, Target is reporting bad numbers, for example, is that for the first 5 months of this year, sales at restaurants and bars were up 15%. The rest, so maybe people being driven to eating and drinking for whatever reason. But the rest of the goods market is not doing as well as the rest of retail. And the other thing is we still have very, very low unemployment. The economy is doing fine. The question is what happens if we even get the modest recession scenario that we're talking about, and the unemployment rate goes up by 100 basis points. So my guess is this is as good as it gets for most retail. Industrial has been the best. You see extraordinary rent growth. This is Prologis data, which is the largest warehouse company in the United States, public company. When you get 20–30% a year rent growth, vacancy rate nationally has gotten down to like 4%. It's going up a little bit. Rents have been very, very strong. It's the hottest area in retail and real estate, and it's part due to online shopping, and closer in warehouses are doing even better than the traditional Prologis warehouses out in Riverside, San Bernardino, and the warehouse market for Los Angeles now is now in Phoenix, is now in Las Vegas. It isn't only in California, it's well beyond California and Northern California. It's in Reno. It's in Reno, Nevada, the warehouse market. So that's been the hottest. That has been the hottest part of the market, where we have rising rents, very, very low vacancies. There's construction coming on, so vacancy will go up a little bit, but it's not going to be a big deal. And rent increases will be a little less. But for the owners, is the embedded rents, the embedded rent growth is enormous, where the current rents that they're charging is maybe 30% below market right now. So all they got to do is sit there and renew leases, and income automatically increases with each lease turnover. In the office market, that's the exact opposite. Every time you turn over a lease, typically you have lower rent rather than higher rent. And then the other issue is in industrial, you don't have a lot of tenant improvements. And in the office market is that people say, well, Century City's great, you're getting $100 rents annual basis, but to move in a tenant probably costs $300 a foot with the TIs, the leasing commissions, and free rent. So the economics of that business is absolutely horrible from the point of view of the landlord. For the tenant is getting, even though a tenant looks like they're paying $100 of rent, they're getting a lot in exchange for that $100. Now, this is what I did a blog post a month ago on what's going on with REITs. And REITs are basically companies that own buildings of various types. And this is I'm comparing the high of 2016 with the close on May 31st. And take a look at the apartment REIT company, Essex Properties, which is the biggest owner on the West Coast of apartments. In 2016, the stock was 240. End of May was 216, down 10%. And you think, well, everybody's making all kinds of money in apartments. What has happened is, even though rents have gone up, cap rates have gone up even more. And as a result, the values have dropped. Douglas Emmett, which owns office buildings all over West Side, also owns that building, on the apartment building in Brentwood on Wilshire Boulevard that's being redone. That was 38, it's now 12. You're looking at Hudson Pacific, which owns a lot of the studio space, and Hudson Pacific did the mall rehab where Google is on Pico and Westwood. That was 38, is now 12. 38.5 is now 5. Kilroy, which has probably one of the better office buildings in the state, probably Carl knows better than I. Brand new, modern, terrific buildings. They were 73, they're 27. Retail Opportunity Trust, that's strip malls. They were 23, they're now 12. So the stock market is telling you that although the physical real estate market hasn't moved a whole lot, the stock market basically trades every day. And the stock market is telling you that values have really dropped a whole lot, even though it may not be reflected in physical property prices. And the one thing that's done great is Rexford, which was founded by Dick Ziman, by the way. And that's gone from 23 to 54 because that's industrial and the market is reflecting the big bull market in industrial space. So what the REIT market is saying is when that physical real estate gets repriced, it's going to get repriced lower. And in the case of office space, it's going to get repriced a lot lower going forward. So thank you very much. The rest of the panel, come up, Stuart. You want to get your panel?
by the forecast this time around. And, you know, if you kind of take away the word recession and you look at the two alternatives that were put forward by the forecast, the lines look pretty similar across the scenarios. And they're suggestive of the fact that despite the gloom and doom that we're hearing and talking about in the office sector, et cetera, where we have an economy that's resilient and an economy that's expected to continue to perform pretty well. So I wanted to congratulate Jerry and Ed and Leo and David and William, of course, for good work this time around. Anyway, I was quite interested to hear some of David's words right now, and I'm going to introduce the panel and then we're going to talk about what we're going to do. Let me start with David. David being a longstanding player around the Anderson School, both at the Forecast and at the UCLA Ziman Center for Real Estate. And you probably know that where we always like to brag about David because David is Anderson MBA and an Anderson PhD. And, you know, if we had a distinguished student award, David would get it every year or something like that. But anyway, very spectacular career on Wall Street and academia, et cetera. So David, you're introduced. Who else? Let me try to go in order there. Carl Molstein to the left of David, executive managing director at Jones Lang LaSalle. Carl is a utility player. He plays all around the field. He has deeper interests in entertainment, creative office, development, and local public policy. And Carl, I hope we'll be able to elicit a few comments from you on some of those topics. To Carl's left is Jackie Levy, who has been referred to and introduced, CFO and Chief Revenue Officer of Caruso Holdings. So he's a very senior member of the executive team of an entity that has a multi-billion-dollar portfolio spanning retail, multifamily, and other sectors. And we're looking for really good intelligence from Jackie. Jackie, thank you for coming over, being with us. And Paige Certain, who we're very dear to all of us, Senior Director at Gauntry. Paige having over 35 years of experience, really an industry leader and expert in areas of commercial real estate banking. So all the metrics that relate to what's going on with the capital markets pertinent to real estate will be divulged by Paige, hopefully. And welcome, Paige. So let me tell you what the game plan is just for the remaining few minutes that we have together this morning. When I was back at the Fed, we do, for the FOMC every 8 weeks, we do a formal, what we call Green Book forecast, a full soup to nuts. Every economic indicator in the United States that moved, we'd forecast and we'd prepare briefings for the governors for the FOMC based on the macroeconomics as we understood it. At the same time, the division director would call the champions of industry around the United States, the deep sectoral leaders, people with deep in the trenches knowledge in order to augment the 30,000-foot review of the numbers based on the macro forecast with some very intimate sector-specific knowledge that would shed additional light and anecdotal evidence with respect to what was going on with the macroeconomy. So that's what we're going to do now. And we're going to do it with probably the most troubling part of the forecast, that being commercial real estate. And you heard the different sectors of commercial real estate distinguished, but we're gonna pay some attention to office and get some input vis-a-vis office. I think the way we're gonna kick this off is to invite each of our panelists to just say a few words. David, maybe we'll save you for last since you just spoke. But Paige, why don't we start with you? And I've invited each of them to just a little bit each from their own deep expertise. And after we hear a bit of that, I have some questions, but please write down a few questions and we're going to open the whole thing up, and it's going to be your time with the sectoral experts. So Paige, why don't you kick it off?
Yeah, good morning, everybody. I think the one thing that I look at when I look at the environment today is it looks very similar to prior cycles that we've been through. With regards to over time, we saw quite a bit of frothiness in 2019, 2020 going into in the capital markets with regards to pricing and structure and just the availability of capital. We still have a tremendous amount of capital today out there today. However, it's not very certain as to where it wants to play or how it wants to be priced. So today, as I look at the market, I think it's very reflective. The capital markets are very reflective of the forecast today with regards to, you know, are we going into a recession? Are we not going into a recession? And then, you know, how do we price risk? And ultimately that pricing on risk is reflective in the values of the underlying real estate. So there is plenty of capital out there. It just depends on what product type you want to play in. You know, industrials is available, you know, apartment is available. I mean, the agencies have continued to be incredibly flexible with regards to the mechanisms they utilize to keep their capital as the most advantageous with regards to the multifamily space. And then, you know, you do see a very much a tightening at the bank levels, more because they just did a tremendous amount of volume. I shared with Stuart a chart from the Mortgage Bankers Association that saw that there was 23% of the mortgage originations that were done over the last few years or let's say 5-year time period were done by the regional, super regional, and large banks. And that's a pretty big segment of the capital markets to all of a sudden have it be sort of, I would say, stuck in the way that it's not, that it's, you know, reached either its capital constraints or its percentage with regards to allocation because other asset classes aren't growing. So, but I would tell you from my company's perspective, there's plenty of capital out there. It's challenging to price and difficult to ascertain, but it is there for the right transactions.
Okay, Paige, do you want to drill down a little bit though in terms of where you see some of the disruption and some of the challenges, and maybe how that's articulated in terms of the transaction volume or the bid-ask spread or other
Sure.
dimensions of pricing of spreads that relate to credit or anything else?
Right. It's you know, for a long time period, obviously interest rates were basically zero. And so a lot of mistakes that were made in the process, whether those are cost overruns or, you know, timing with regards to delivery of products. We had a lot of that specifically impacted by COVID with regards to, and then absorption of product. What's resulted is that, you know, the cost of capital has gone up so quickly that it can't really, a lot of the product that was put out there that would have been able to solve its own problem by going to the cheap, inexpensive capital markets, I should say, you know, are not able to do that. We haven't really started to see that pain in the market. But you can go in any day and, you know, go to similar like type lenders, and you'll find that in one shop, you know, and if you're talking a very conservative leverage, in one shop, your spread may be 140, in another shop, it may be 160 to 175. And What's the reason for that? A lot of the reason for that is that they can invest in alternative investments like a corporate bond that's much more liquid and is priced at that level. And so internally within, you know, the organizations that are putting this money out, they're looking at what's the highest yield at the best liquidity rate. So that's part of your challenge. You're also seeing, and then I would say in the CMBS market, which is probably the most unpredictable segment of the market today, you see more of the business being driven by the A-piece buyers, whereas historically the B-piece buyers had been, you know, the people that bought more of the risk, who got more of the yield, had more control over what the ultimate composition of those pools looked like. Today, the A-piece buyers are saying, look, I'm buying a AAA bond, but I don't want to have more than 20% office in that. Well, for the originators who are the shops that are originating those, they then have to put more capital, more assets in that are alternative classes. So you're finding when you go out that the bid ask that you're going out in these things could sometimes be 40, 60 basis points of a spread from providers that offer a similar product. The other aspect that we've seen a lot of is the shortening the duration. So for people that have only been around for the last 10 or 15 years, you know, interest rates have always been low. For those of us who have been around through multiple cycles, you know, we used to underwrite to a 10% interest rate, and it's 6.25% interest rate is a pretty reasonable interest rate if you look over time. But it's caused a huge adjustment on these projects that have been underwritten using a 3 cap or a 4 cap, because now the capital is higher and they have an equity requirement that they didn't anticipate, which will ultimately force a sale. The insurance companies are in the market. For my company, they tend to be a significant portion of our annual origination. About 60 to 65% of what we originate is through our correspondent network. And they are in the market, but they are sometimes on pause. Many of them have consolidated. So you see smaller originators now using other platforms, so that you go to a particular insurance company and they may have 10 different lines of business that they're originating loans for. Many of those products are now focused in the shorter term duration. People are looking at a 3 to 5 year window period of when they think interest rates will actually come down. So we call it the bridge to bridge phenomena. And clients are seeking more of that duration capital than any other capital.
Very well. Very well. Thank you. Thank you, Paige. Jackie, let's transfer the ball over to you. And I'm sure every single person in this room has experienced the Caruso retail properties, probably don't know much about the Caruso multifamily, but Jackie, elucidate us, please.
Well, first off, thank you for the kind introduction, Stuart, and thank you to Anderson for having me here today. I got to say, all the speakers ahead of us were exceptional today, very informative, and so thank you for the great content. For those of you that are not familiar with Caruso, we're a privately owned company. We finished 2022 with 3 shopping centers that rank amongst the top 10 in terms of sales per square foot in the country: the Grove, the Americana, and Palisades Village, according to Green Street. I've got to say, 2022 was an exceptional year for us. We finished with our best year ever, and we're projecting 2023 to be our best year yet. A lot of it is driven by what Jerry mentioned earlier, in terms of the pent-up demand that came from COVID, people wanting to go out, spend money, and get out from their homes. But we've also noticed some other trends that are taking place. From a retail perspective, a lot of the big brands and luxury brands that have a big wholesale footprint have decided to take the representation of their stores into their own hands and are focused on opening up more standalone stores so they can control the guest experience and they can control how it's delivered. We obviously have recognized that it's a very there's a lot of turmoil around us in terms of safety and homelessness. And so not only do people have an expectation and want to feel safe, but we at Caruso and our properties have been very focused on making sure that they are safe. We've invested quite a bit into additional security measures to make sure that there is an additional level of safety and security, and some simple measures like, transitioning from plainclothes armed officers to visible armed officers. So people know that they're there and it serves as a deterrent. We finished 2022 with an occupancy of 98.5%, the REIT average. And when I reference the REITs, it's mainly a comp set. We study the comps quite closely. Unibail, Radamco, Westfield is 1, Macerich is 2, and Simon is 3. I think their average in 2022 was 92%, so better for them as well. We studied first quarter rent growth. The average rent growth for the REITs, Macerich finished first quarter up 6% in terms of rent growth. Westfield was up 13%. Our rent growth was up 52%. So we're seeing staggering growth and staggering demand to be on the properties at this point, much more robust than we've ever seen. In fact, I think there's roughly 1 million square feet of retail demand that we currently can't satisfy on the properties, which is obviously a great problem to have. I do recognize the headwinds that are ahead of us and a lot of the factors that have been spoken about with the speakers ahead of me. And I think the best thing we can do, and I'm not just saying this because I'm at a UCLA forum, but John Wooden once said, failure to prepare is preparing to fail. I think we've all got to prepare for a recession, whether it comes or not. We certainly are. We are preparing as though the interest rate environment that we're in today is going to stay for a while. You can speak to this better than I can, but I think it's been 22 years since the 10-year had a 4 in front of it. But historically, before then, a 4 was a very good rate. And so we're treating it as such and we're planning as such. But I think the best way to do it is obviously look at ways to grow your revenues, your ancillary revenues, which we're taking a good look at, and we're taking a look at sponsorship revenue and advertising revenue and other ways to grow revenues, but also being really focused and diligent on expense management and identifying opportunities to reduce expense where we can.
So Jackie, that's super interesting. Let me, if I could just follow up for one brief second. There's Caruso and the metrics that you've described for the outstanding achievements of the Caruso holdings. There's the rest of retail. And then there's the macroeconomy and the consumer. If you were going to step away from just the results that pertain to Caruso and speak a little bit about your reflections on the consumer spending portion of the forecast and consumer sentiment and what's going on out there with the consumer based on your study of your competitors and everything else, is there anything further you'd like to offer us on that point?
Certainly. I think in terms of retail generally, we've been very vocal in terms of our thesis where people want to be outdoors. So I do think that the traditional enclosed mall is probably going to have some more headwinds than we've got in an outdoor environment. I think even more so exacerbated by COVID and people wanting to be outdoors. I think the department stores have a lot to figure out, especially in light of what I mentioned with regards to wholesale and retailers like Nike being very vocal about wanting to shrink their wholesale footprint and focus on their stores and how they deliver it. But what we're seeing is strong consumer confidence and consumer spending across our portfolio. And in talking to colleagues across the REITs that I mentioned earlier, 6%, 13% rent growth is nothing to scoff at. Now, what I can't speak to is how much those deals are costing them in terms of tenant allowance and leasing commissions and other costs. But I think their occupancy is also up, being at 93% on average. So I think we are seeing people wanting to go out and spend. I do agree that restaurants and bars have thrived, certainly. But you're also reading a lot about the growth in luxury. And our properties traditionally have not seen a lot of luxury retailers, but over the last 3 years have seen robust interest in luxury growth, whether it's Gucci, Saint Laurent, Louis Vuitton. They've opened up their first locations on our properties at Americana and the Grove at this point. So feeling really bullish. In terms of the hotel segment, we have the Rosewood Miramar Beach in Montecito is the first hotel we opened. We opened it up in 2019. And running an ADR of $2,500 a night. It's performed exceptionally well, but you look at the comp sets, whether it's Montage, Laguna Beach, Belmont, El Encanto, and they're seeing strong growth across that sector as well. And I recognize that hotels that have focused largely in downtowns or business populations have struggled more so than the traditional resorts. And hopefully those urban hotels see a pickup. But we feel very fortunate that we've got 500 linear square feet of oceanfront property in Montecito, which is idyllic. So,
to say the least. Okay, wonderful, wonderful, Carl. We could ask you any question about almost anything, and I'm sure that there would be some really interesting things that you'd have to say, but. I'm curious about two things, and I'm sure the audience is curious about a lot of things, and you may have prepared on all sorts of levels, but I'm very interested in your take on the sociology of office and whether, as David said a few minutes ago, we have some permanent earthquake-like seismic shift in the prospect of the office sector, or whether indeed we should condition that remark David made in one way or another. And I'm not, David, trying to put words in your mouth, by the way. And the second thing, Carl, I'd really like to hear your thoughts about is very local to LA, and that's downtown versus West Side. And, most people in this room have written little death notices for downtown LA, and you see the pricing in downtown LA and talk about this geographic as well as mix shift over the West Side. On the other hand, David put out a chart that said that the West Side REITs, notably Douglas Emmett and whatchamacallit, the entertainment Hudson Pacific are doing abominably. So I've said enough. Why don't you do whatever you want with that?
I feel like we won't turn this into the office funeral. So sociology in the office. In '99, I joined John Cushman, and I would drive up to 601 Figueroa, and I felt like I arrived. I mean, institutional quality building, brass, wood, go up to the 47th floor. John had his Remington art collection out and his mementos, and we were masters of the universe at that point. Did a lot of business. My son helped me move 10 years ago to JLL, and I went from a 400 square foot office with my own conference table, etc. We come up, the freight elevator opens. I said, just put my boxes over on that workspace. My younger son worked at City National at the time. In a bank, you don't go from a 400 foot office. He comes up to me, puts the box down, puts his hand on my arm. Dad, is everything all right? You can tell me if you were fired. So we did a lap, and I showed him the new world order, how, this top producer sits at this desk and all that. Well, fast forward 10 years to today, when I come into our next remodeled office, I will probably not have an assigned seat. I will probably have a locker. I got to make room in my home office for all those mementos and, Carl, you're the best and you won this and you sold that and all that. And that's the new world order. So with that, reduced footprints is evident. Law firms, one firm downtown drew a stencil of a law library on the wall as a memory to what used to be a law library. The support ratio of 1 to 2, 1 to 1, 1 to 2 seemed to be a good storage area for boxes now as the young attorneys come in with their laptops and if they come in. And with technology, I think COVID has, and we studied the user quite a bit, that with COVID, it's done. This, if you don't have the technology for variable parking card usage, if you don't have amenities, if you don't have security, etc. And in my intro, you mentioned public policy, and I'm a bit outspoken on that. It's sort of my anger management tool with what I say. So you're sitting at your home office, and we're trying to correct a pattern that's been going on for a couple of years, right? A lot of us have gotten used to it and figured out the dog and whatever, interruptions we figured out. All right, I really miss the office. I want to go back and throw out my dead plants, say hello to a few friends, just get back into it. And so, all right, what the hell's all this traffic? The buildings are at 50% occupancy and the freeways all seem to be 150% occupied. Then you pull up to the building and wow, parking $4.20 for 10 minutes. Gee, that's inviting. Never mind, I just paid, $5.50 for gas when before COVID it was $3.75 or whatever it was. So you finally get up there and no one's in the office. I mean, here and there you see someone. So we're working on studying the workplace and the merger of residential and office is really closing fast. Headroom, window space, open area. I design nicer kitchens and offices than a lot of people have at home in terms of that community. If I see one more virtual golf in an office building, since I don't golf, I'd rather have a Peloton there with a screen, but so be it. So we're working with a lot of the owners. We're sharing the responsibility with the employers. The employers are on the hook for these leases. They really want the people to come back and use the space. They're paying for it. But it's a team effort today between the landlord and the tenant to create that environment, create the systems to bring them back. So with that, a couple trends. The old days of landlords being obsessed with the tenant's credit, that table has turned. The tenant now, I was on a phone call where a tenant was questioning a landlord about their ability to perform, pay the TIs, stick around for all their obligations. Household name. And the landlord starts with this canned speech. We have never given a property back. And everyone on the call literally broke out laughing. Because you pick up the paper today and you see the Brookfields and the Blackstones and all these multi-billion-dollar organizations, which historically we all had a problem asset and they would hide it. They would just put it in the portfolio and not draw attention to it. Today, every asset is a standalone SPE entity with separate debt. And gee, it's not working out, get rid of it. And they don't care about the negative press or connotations. So today, credit worthiness of the landlord is as much an issue. Shell space now is virtually impossible to lease in Los Angeles because so few large tenants are out there with project managers and space planners, and it takes now close to 2 years from starting the search to move in. The Google space at One West Side, they're paying rent. It's still not finished on construction. So it just takes a long time. And construction costs are at record amounts, and the tenants no longer have the latitude to take $50, $100, $150 from the landlord and expose themselves to $100, $150, $200 overage, which they have to amortize over 10 years. So spec suites, lessons learned from co-working, easy in, easy out, form leases, spec suites, very much in vogue now, even for full floors. So we're going to continue to see that. The sublease market, all these stats that we saw today, I understand how they're computed. They're computed locally and they roll up statewide and then nationally, and they have a certain methodology. They don't include the 9.5 million square feet of sublease space and growing right now in the greater LA market. Think about that. You mentioned Farmers this morning. They put 500,000 feet up for sublease in Woodland Hills. Even if they find a tenant, even if, what are the odds of that tenant renewing and staying in place? Tenants who grab subleases squeeze into them because they're a bargain, spread out in them because they're a bargain, accept whatever the design and technology is as is because they're a bargain, and the renewal probability is very light. So we have the low occupancy in office buildings. Nationally, everyone checks the swipe cards on the elevators. And I think the average is 50, 55%. I'm sure that's not Monday morning or Friday afternoon.
Right.
And then you have the vacancy and the sublease. So what's happening? LA, many of the coastal markets have lessons to learn after 9/11 in Lower Manhattan. That market was decimated. It was an office market. There was no residential in Lower Manhattan. And they became vibrant, it became a vibrant mixed use setting. And so with that, I champion two things. I call it from receivership to residential.
Yeah.
We're finally getting the values of office buildings down far enough where they start penciling out for residential. I hosted a panel with Vince Bertoni, head of planning department. The city of LA has just come out with its own adaptive reuse ordinance. This is nothing new. Carter Hawley Hale's headquarters downtown became the Standard Hotel.
Yeah.
Lloyd's Bank headquarters became the Pegasus. There's 100 of these examples from previous administrations that we need to re-embrace and get going. It's more complicated today because of earthquake issues, seismic retrofit. It's funny, you can work in a 1980s office building, 3 shifts a day, seat 5 people per 1,000. The second someone wants to take a shower or a nap, you have to do a $60 million structural upgrade. So I don't get that, but you know, our city, our smart city knows how to interpret that.
Carl, maybe we'll save the second half of my question. Is that okay?
Yeah.
Just the daunting remarks and yet the last statement being incredibly encouraging and hopeful. But I was thinking, given the time frame, maybe now we'll get David back into it and ask David for something very unusual from David, a bullish remark about the office space. David is kind of one anchor of the Anderson forecast here. And what do you have to say, David? A bullish remark. Is there such a thing now?
No, the thing is when we, the assets have to get repriced. And the market's going to work. When the assets get repriced, all kinds of good things will happen. If you get people maybe coming back to the office, maybe you'll get more residential conversions, but that's going to take time. But the thing is there's one issue which I didn't discuss, but I'd like to discuss now is most of a good chunk of the real estate debt is held by regional and community banks. And basically the regulators are really looking closely at these real estate portfolios, and you have loans on fully leased buildings that they're being sold at a discount because they know they're going to have to reserve against them later. And so there's a quiet credit crunch going on, especially for office and for other assets too, even in some cases, even for retail and even for apartments, because cap rates have moved up from, call it 5% to 7% or something like that. And you have to, the owner has to put in more equity. And in many cases, the owner doesn't have the equity. So this is going to be a long, my sense is this is going to be a long, slow bleed for this thing. And it's going to take lots of time. And we're going to have to re-equitize a lot of buildings. But the question is if you look at these, the Brookfield buildings downtown, the Blackstone buildings downtown, they chose not to put in more money into the building. They made the choice. They're very, very, very sophisticated investors. They chose not to put in, and they don't want to pay $350 a foot in TIs and leasing commissions to get somebody else into that space. So this is, I think on the office side, it's going to take a lot of time. And the difference between 1990, which I lived through very well. In fact, I was in a meeting with the Greenspan and the whole Fed board on real estate in 92. And the thing is you could say the world could get better. And people go back to the office and everything. You could make a whole bunch of arguments, extend and pretend, a rolling loan gathers no loss, and all this other stuff that the bankers want to do. But some of these buildings, you got to get the pricing down to a level where they're either converted into residential, and that generally requires floor plates less than 16,000 square feet. You know better than me, Carl, but something like that. Or alternatively, they're going to have to get, some of them are going to have to get scraped. And that's just the reality, because when you have so much, in the United States, we had all these steel mills in the 1950s and 1960s. And they got scraped. And the office market is a capital good, and so something similar is going to happen. And the better located, most efficient buildings, what have you, the most efficient plants, if you will, the most efficient steel mills are still around. And I think that's what's going to happen to the office market. And there are assets that were once viewed, you're John Cushman's building, Class A, the best, and stuff like that. Is Class A has really depreciated far more than what anybody thought. Now, I could say nice things about apartments. I could say nice things about industrial. I could say nice things about my friend's retail over here. But that's going to work. And the other thing with home office is part of the reason why rents have gone up for residential is there's less money available. There's more money available because people aren't commuting. So you could pay that as that commuting money could go into rent money. And the other thing, if the home is going to become a home office and stuff like that, you're going to need more space, and you're going to be willing to pay more money for the space, because it's not only a residence, it has a dual purpose. The building you're living in, whether you're renting it or owning it, it's now a dual purpose building. Like in my house is the most valuable square footage in my house. Normally you say it's the kitchen or something like the most valuable square footage is my home office. That's the most valuable per square foot is the most valuable piece of my house.
So that was pretty bullish. And I do want to say that I'm a regular reader of David's blog. He has an amazing blog. I recommend it to all of you. It does have some bullish elements to it. It's really an opportunity for we could all go on for a long time in conversation amongst us all, but it's a opportunity for you all to jump in. And why don't we just open it up? Yes, sir.
I wanted to ask a question that Jackie raised, which is the importance of safety and security and why that lesson has not been picked up by municipalities. I live in San Francisco. Park Hotels just gave back the keys on 9% of hotel rooms in San Francisco. They were able to look out through 2027 and look at the convention business, which is not coming to San Francisco in large part because of safety, security, and the streetscape. So why do our leaders keep pouring gasoline on the fire?
Well, I think you know where I stand on that one.
I mean, we had a similar conversation about the transportation infrastructure that we have, that we're spending so much money in putting in this infrastructure. But people are afraid, and especially in San Francisco, people don't want to take mass transportation because they're afraid. So, and we have the same issue where a lot of the workers, the reason why companies located in downtown Los Angeles was because they could attract quality workers at a lower cost, and there was mass transportation. And I think some of the pushback that they're getting is that these people don't want to get on mass transportation because they're concerned about their safety. So I agree with you. I think it's not just it's a municipality issue, and it's a transportation issue for sure.
I agree as well. I mean, whether it's office or whether it's residential, the bigger issue is both of those asset classes, the people that reside in them or work in them want to feel safe. And if you don't feel safe, you're not going to want to work there or live there. And I think that's part of the reason why you see Century City thriving and downtown LA not thriving.
And from a physical point of view, in downtown LA, especially south of 7th, the buildings come right up to the sidewalk. On Bunker Hill, they're set back in plazas. So far, we still have the right to govern our private property. In Century City, there is no public parking. And again, the buildings are all set back in plazas. So just from a physical design, I guess the perps didn't get the memo that they could go there and do whatever they want to do. Real simple design aspect.
Yes, sir.
Are you seeing foreclosures in new construction?
In which asset class? And any? Very embryonic. Very embryonic. A lot of restructuring, a lot of operating partners saying, I'm done because after the waterfall, my 5 or 10% of the gross proceeds now goes to that mansion tax. So I have no incentive. I'll just sit here for fees and take good care of the asset. So I think it's still very embryonic. Right before the mansion tax deadline, a lot of lenders joined with borrowers to sell it one-off because a lender, the Rubin brothers who foreclosed on the Fairmont Hotel in Century City and the unsold inventory, that was $1 billion foreclosure. They wrote a $50 million check to the city of LA. You tell me now how many billion-dollar lenders want to come to LA and issue debt. So just starting.
Yeah, I think also you see a lot of this in this interim, sort of the bridge to bridge I was talking about. It's people coming in and they're able to maybe get out of their floating rate debt and recapitalize with, you know, some mezzanine or some preferred equity and sort of kick the can down the road, but the problem isn't solved. So I don't think we're going to see that this soon, you know, because of the product type that is maturing, but in the system overall. But I think that we will see it, and it'll probably be a longer duration of when we start to see that expense for the market. There's still a big, what's it worth? I mean, if you have to get 3 opinions of value to sell an asset and you're a professional, right? This is what you do for a living, but you give 3 values so that you make sure you're marketing it broadly. Whereas, historically you might have done a pocket listing or done an off-market deal to save a little bit of money. That's not happening today. So.
With regard to the adaptive reuse you mentioned, and I assume you're getting towards multifamily, similar to Lower Manhattan after September 11th. I've been to a number of real estate conferences where people say it's the building, it's the dirt minus the cost to demolish this office building is what it's really worth. Is that the floor plates and such are so challenging. Is that accurate? I mean, or is there a little bit of each certain percentage you can adaptive reuse, or you have to demolish the whole thing?
There's a lot of covered land plays with suburban office buildings in Thousand Oaks, in the South Bay, et cetera, that have surface parking.
Yeah.
And because of that large footprint, Fashion Island had a couple great examples where they tear down the under-improved and they put in wrap construction apartments. I'm referring more to a downtown LA where Brookfield just finished the Beaudry at 8th and Figueroa. They had the land for free. Probably came in order of magnitude $900 a foot. The Union Bank building down the street just sold for $140 a foot, fee land, parking in place. Union Bank is getting absorbed by US Bank. There's a rare moment in time you can empty that building. So if you put $400 a foot into it to convert it, and you lose the rentable to usable, so you're at $500 a foot, you're still way ahead of $900 a foot. And construction costs in LA, inflation, deflation, et cetera, we have billions of dollars in public construction going on. We have, airports, metro, all that. Construction costs have not come down at all.
And they're
So-
not projected to. I
Pardon?
mean, realistically, they're not projected to.
No, they're not projected.
Yeah.
If there isn't an additional question, Jerry, do we have time for one more from me, or you're ready to wrap? Okay. Future of economic activity across space. And what I mean by that is city, suburb, exurbia, rural, interior, California, Texas, Hong Kong, et cetera. What do you all have to say about that? I mean, we had a emptying out of cities that was part of the COVID story. We have demands for residential space that have been articulated that are consistent with revitalization of suburban areas. Similarly, with respect to crime, people aren't commuting to downtowns. We have a lot of evidence that downtown San Francisco and downtown LA are in terrible shape. David himself lives in a highly amenitized neighborhood in Santa Fe, New Mexico, having fled New York City and various other locales where he's lived. What do you guys have to say? Are we looking at 10 years where Jackie, your retail center in Westlake Village is going to be a model of all that's good in life, or are we looking at a future where, in fact, some portion of California is moving to Nevada and Arizona to lower tax, lower housing costs areas, and California turns red again, or what's going on out there? Let's do, since I'm talking too much and it's almost 12, let's do 2 minutes each on the geography of economic activity as it changes in the next 10 years. David, we'll start with you.
Well, the thing is even though in New York, even though office building areas are totally empty, where people live, it's thriving. So wherever you have a lot of residential activity and basically home and office are merging. So you could have very vibrant places within existing cities. But to me is the real issue is crime in schools. And the cities could fix crime in schools. Cities are going to be great. If they can't fix crime in schools, it's going to be all suburban.
Perfect. Carl.
Wow. In 1977, a Valley boy looked at downtown LA and said, "That's where I'm going to start my career." And I went down there and haven't looked back. The city still holds an appeal. The hub and spoke hasn't worked out. Why wouldn't a Latham and Watkins in downtown LA open a 10,000-foot office in Calabasas for the partners who live out there, a 10,000-foot office in Manhattan Beach, vice versa?
There's a bunch down in Orange County.
Pardon? Well, Orange County is a whole separate market, separate client base. But I'm talking more hub and spoke in terms of I work at home, I can pop in. WeWork, which was probably delisted this morning, was betting the farm on that enterprise tenants would decentralize and move into their locations everywhere. I'm seeing the reverse. I'm seeing getting more centralized, getting people under consolidations under one roof. But there's a lot of pain. We're in for the great reset. Most investors who I deal with are pencils down for 18 to 24 months because they just want to take a pause, and they're focused on asset management issues of what they already own. They're trying to figure out what they own. So I'm still a big believer in the center of the city.
Okay, Jackie, thank you.
I tend to agree with a lot of what David said. I think schools and safety are a huge priority for people. I think localization has also become a huge priority for people. They want to live, work, play close to their home. I think the shift to suburban areas and communities in large part speaks to the want and the need for great schools and great safety. So in areas that we've got properties like Calabasas and Thousand Oaks that have safety in schools, we're doubling down. We're taking a look at taking unused land or parking fields and converting them into multifamily, adding multifamily there. It works really complementary with the retail that we've got there. So we recently announced that we're looking to add multifamily to Comets at Calabasas. Calabasas has been a great community for us. The average household income, I find it no coincidence that the average household income in Calabasas now surpasses Beverly Hills, and it happened right around COVID. So
plus the Kardashians, so whatever. Okay, good to hear. Thank you. Paige.
I do agree that, you know, from a community standpoint, from the retail, residential, work from home, we all like to be in our communities, and that makes us very centered. I think we used to be able to do that and commute, and I think there's a disconnect from that today. I think that if you look at some of the communities you're talking about, they're not completely built out. There's still room for expansion. People feel that openness when you live more in the city, like where you and I live. There's not really anywhere to go. So you've really it really plays to the local mindset of how do we go from a small little community and densify our community, but still maintain our safety, our good schools, and the quality of our life. So I'm for keep it close to home, suburbia.
Okay, so the answer in case, in one word of the four panelists is both. I think. Anyway, Jerry, it looks like we're done.
Yeah, so no dystopia, but to quote from a title from Jane Jacobs' book, we've just heard about the death and life and future life of cities and what they have to offer. So please join me in thanking Stuart and this amazing panel. And many thanks to Stuart and the Ziman Center for Real Estate for joining us as a partner in this event today. And we have a long list of sponsors, and I'd just like to reiterate that we couldn't do these events without their support, and we are most grateful. But also, if you didn't hear your organization's name there, let us know. We can fix that. Our next event is going to be on the first Wednesday in October, and it's usually in September, but our students aren't coming back until the 28th of September. So first Wednesday in October, we very much look forward to seeing you there, and we'll be able to give you an update on recession or no recession. So thank you for coming. Thank you to our virtual audience. And for those of you who are here in person, California employment is doing well, so it's time to beat the rush hour. Thank you. Be safe.